We will resume this morning with Dr. Moran, and I will ask council if there are any matters we need to address before we turn to his redirect.
Chair Mitchell, very briefly.
Go ahead.
The company made slight modifications to the witness schedule to accommodate travel and other availability issues, and have provided that to all parties as well as the commission. So we'll be slightly following that modified schedule this morning.
Okay, thank you, Mr. Durack. All right, anything else from the company?
Nothing else.
All right, this morning we will go until 11 o'clock, at which point we will break for lunch, and then we'll come back on the record at 1 o'clock, just to let you all know where we're headed today.
Chair Mitchell, one other preliminary.
Go ahead, Mr. Neal.
My understanding is, as it stands, for NCJC et al. Panel Duncan and Hill, that I believe SIGFR is the only party that's currently listed cross. And it's my understanding that if no one else has questions and the commission doesn't have questions, that SIGFR would be willing to waive cross if and waive their appearance.
All right, so I will treat your comment as a motion, but I will check in with my colleagues to see if there are any questions for those witnesses. Okay, we will resolve the motion after the lunch break.
Thank you, Chairman.
All right, with that, Mr. Durack, Mr. Mehta, you may proceed.
Thank you, Chair Mitchell, and for the court reporter, I'm Kiran Mehta, here for Duke Energy Progress. And Dr. Moran, I thought this morning we would just pick up where Mr. Freeman left off yesterday. And he was asking you about what had been previously marked as Public Staff Potential Exhibit 10, which I expect is in that great big white book in front of you. It's the RRA report concerning adjustment clauses, state by state. And it has been remarked as, and I won't go through the entire litany, but for purposes of the hearing, Public Staff Exhibit 16, but in your book, Potential Exhibit 10. And Mr. Freeman was asking you about a section of that RRA report called The Take, which you'll find on page 5. Do you have it?
I do.
And he asked you to read from the first paragraph of The Take. But he forgot to have you read from the second paragraph. So I thought we might do that together. And the first sentence of the second paragraph states, "The use of adjustment clauses has expanded significantly." Do you see that?
Yes.
And the fact that they have expanded significantly is, in fact, your point regarding these adjustment clauses. They have become, in effect, ubiquitous.
They have indeed become mainstream in the industry.
And so mainstream that if you were to put together one of Mr. Freeman's famous maps, virtually every state in the union would be colored in because it would have some form of an adjustment clause. Is that right?
That is correct.
And is the ubiquity of these adjustment clauses the reason they are, quote, baked in, to use Mr. Freeman's words, baked into the underlying economic financial data?
That is correct. Investors, of course, take risk into account. And to the extent that these mechanisms reduce some of the risks, they have already taken that into account. Bond rating agencies reacted favorably to the presence of these risk mitigators, and the stock market and stock prices have reflected the presence of these mechanisms. So it's already in the data.
And Dr. Moran,
similarly to fuel adjustment clauses.
Dr. Moran, in the smaller book that you've got up there that lists or includes potential redirect exhibits. Go, if you would, to DEP redirect number 5.
I'm very familiar with that. Thank
Chair Mitchell, I would request that DEP redirect number 5 be remarked as DEP redirect Morin direct and rebuttal exhibit number 1.
All right, the document will be so marked.
And Dr. Morin, this is a chapter from your book, correct?
Yes, sir.
The most recent book, the Modern Regulatory Finance book.
Yes, sir.
And specifically, the excerpt that we have as DEP redirect Morin direct and rebuttal exhibit 1 is chapter 3.3, which is titled Risk Mitigating Mechanisms, correct?
Yes.
And if you turn over, Dr. Morin, to page 58 and 59 of the chapter, there is a subsection called Impact on Risk and Return. Do you see that?
Yes, sir.
And the first paragraph indicates the presence of riders, trackers, and other risk mitigating mechanisms raises the question as to whether such a mechanism reduces business risk and to what extent the cost of equity and required returns should be reduced, if at all. You see that?
Yes.
And that is, in fact, the question concerning the impact, if any, of these risk mitigating mechanisms, correct?
That is correct.
And your answer to the question in the book is no. And that was certainly your answer to the same question in your testimony, your rebuttal testimony. But I'd like for you to explain, using the book if you want, to the commission why that is so.
If you look at the middle paragraph of that exhibit, and I can quote here, first, the ROE in a rate case is being set using proxy groups of comparable companies. To the extent that companies in the proxy group have similar risk mitigating mechanisms, the use of proxy groups takes them into account, and the addition of any discrete adjustment would be unwarranted double counting of the effect of these mechanisms.
So that's the baked in point that you and Mr. Freeman discussed yesterday.
Yes, the current market data reflects or embeds the presence of risk mitigators.
So if you go over to page 59, then, Dr. Morin, you list in the middle of the page a second reason why the answer to the question posed at the start of that section is no. And could you explain to the commission the second reason?
Yeah, there's been some empirical studies in journals, academic referee journals, that have examined the impact of risk mitigators on the cost of equity. And the results of the one particular study cited here, and others as well, is that there is no impact. And again, why is that? Well, the reason's simple. It's already in the data, number one. And number two, investors, and that's a little bit of a conceptual justification, but investors really only care about risk that is not diversifiable. Risks that can be diversified away are not priced in. So if investors are diversified, which they are, they can eliminate all these company-specific types of risks, these anomalies, all right? When perhaps the presence of risk mitigators is a diversifiable risk, like weather, for example, is diversifiable across many regions of the country. And the same could be true for risk mitigators. So maybe that's another reason why it simply doesn't show up in the cost of capital estimates.
And you've got a third explanation in the following paragraph. And I think that's what you just provided us. Is that right?
Yes.
And so, Dr. Morin, your conclusion with respect to the question posed, do these risk mitigating mechanisms impact, and if so, to what extent, the cost of equity, is in the final paragraph of this section down at the bottom of page 59. If you could read that to us, please, sir.
To sum up, allowed ROEs should not be adjusted downward in order to account for the impact of risk mitigating mechanisms on the company's business risk, because market-derived returns are estimated from market information on the cost of common equity for other comparable companies, which already incorporates the impacts of these mechanisms. To do so would constitute double counting.
And Dr. Morin, yesterday, when you and Mr. Freeman were talking, you brought up the recently decided Carolina Water Service decision from the commission. I think it was decided just a few weeks ago. Mr. Freeman promised you that he would get to that decision, but he either forgot or moved on. So I wanted to ask you about that decision as well. And the decision is been previously marked as DEP potential cross exhibit number 36. So if you could get that, do you have that?
I have it in front of me.
And Chair Mitchell, we would ask that the DEC potential cross exhibit number 36 be remarked as, DEP potential cross exhibit 36 be remarked as DEP redirect Morin direct and rebuttal exhibit 2.
All right, the document will be so marked.
And Dr. Morin, just to fast forward to the commission's ruling and conclusions about, again, the issue that you posed in the chapter 3.3 of your book, that is there an ROE effect of these mitigation mechanisms? Go to page 43 of the decision, please, sir.
I'm there.
And if you could, then take a look and just read concerning the commission's conclusions about the MYRP adjustment.
Yes, at the bottom of page 43, starting on the second line, the commission is persuaded that this type of mechanism is prevalent across the country and within the proxy group. Although a WSIP is intended to reduce regulatory lag, the existence of similar mechanisms across the country and in the states where the proxy group utilities operate indicates that the comparative risk reduction associated with a WSIP for the water company, in this case, is 0.
And Dr. Morin, that's a data point that Mr. Freeman missed in your discussion with him yesterday. Is that right?
That's correct.
Now, Mr. Freeman also asked you about public staff potential cross exhibit number 20, which again would be in the big white book that's next to you, which was then remarked as hearing related exhibit 15. And that's the March 2022 Moody's credit opinion for DEP. Do you have that?
I do.
I don't, so I need to pull it up. Here we go. Now, Mr. Freeman, Dr. Morin focused on a single sentence in the last paragraph on page 1, in which Moody's indicated that if properly implemented by this commission, the new cost recovery framework enacted by HB 951 would be credit positive for DEP because it would reduce regulatory lag, correct?
Yes, sir.
Now, had Mr. Freeman walked you through the other parts of Moody's credit opinion, we could see that Moody's remains concerned about regulatory lag in North Carolina, would we not?
Yes.
So, for example, on page 2 of Moody's credit opinion, Moody's does indeed identify the new PBR framework as a credit strength, correct?
Yes.
But it also identifies the lack of tracker rider mechanisms for cost recovery as a credit challenge.
That's correct.
And Moody's also indicates on page 2, down at the bottom of the page, that a factor that could lead to an upgrade as credit positive changes include more riders and trackers to reduce regulatory lag and improve cash flow. Do they not?
They do.
And on page 4, or actually we can even go to page 3, Dr. Morin. In the section that Moody's has called detailed credit considerations and then credit supportive regulatory environments, the second paragraph there indicates again, or Moody's comments again on the absence of riders and trackers that could, quote, serve to reduce regulatory lag on investment or to speed recovery of coal ash remediation. Do they not?
Yes, they do.
And on page 4, Moody's again calls attention to continued lag in the recovery of ongoing coal ash remediation, storm costs, along with elevated capital spending for grid modernization, correct?
Yes.
Now, Dr. Morin, did Moody's say anything in their credit opinion about whether the new cost recovery framework, even if properly implemented by this commission, would reduce DEP's cost of equity capital?
No, there's nothing in any credit rating reports that relates to cost of equity. Bond rating agencies are concerned with the quality of the bonds, the credit worthiness of the company's bonds. They are silent on the cost of equity impacts.
Turning now to Public Staff Potential Exhibit 19, which was marked by Mr. Freeman yesterday as the hearing exhibit 14. This is the S&P Global credit rating for DEP, correct? This would be in the white book, the public staff book. Sorry. Yeah. I make no comment on the fact the public staff book is white and ours is black. That has nothing to do with anything.
I would have expected to be blue in the Carolinas, but anyway.
Oh, well, depends. Depends on what
Depends.
shade of
Yeah,
blue.
yeah. What is the number?
19.
I haven't.
And this is the S&P Global credit rating for DEP, correct?
Yes.
Now, Mr. Freeman had you focus on what is identified on the very first page as key credit strengths. I'd like to look at what's immediately adjacent in their table about key credit risks. And the first one they identify is that DEP's service territory is exposed to hurricanes and severe storms. You see that?
I do.
And they say it's partially offset by securitization legislation, but only partially, correct?
Yes.
And they go on to say that there is an ongoing clean energy transformation Do you see that? The very next point?
Yes.
Dr. Morin, yesterday you testified about the perfect storm impacting the utility industry generally. How does this factor relate to your opinions and testimony regarding the perfect storm?
The perfect storm refers to the paradigm shift that is occurring and will continue to occur in the industry as we move to a decarbonized society, basically, as we move towards a renewable energy environment. And that's pretty risky. It's got risks with regards to demand. What will be the impact on the distributed generation, on the demand for the utilities, products and services? What about the technical engineering types of problems related to the engineering matching transmission with the renewables like solar and wind? That's a huge challenge as well. How will these perform over time? The company will have to raise literally billions of dollars in the next several years, half of which will come from debt approximately, the other half from equity. And will the rates of returns be accommodating so as to raise these vast sums of money? External financing is very risky because we're at the mercy of fickle capital markets as well. So that's what I was talking about in the perfect storm. You have a sort of a leveling off of consumer usage of energy while labor costs, materials costs, and interest costs are going up at the same time that you have to raise record amounts of capital. And that's what I mean by a perfect storm.
And in fact, Dr. Morin, if you look at the third point that S&P Global makes, it indicates that another key risk factor is negative discretionary cash flow requiring external funding, correct?
Correct.
And external funding comes from debt and equity investors, correct?
Yes, and that is risky.
And the final risk that S&P Global identifies is the persistence of regulatory risk in South Carolina. Is that what they say?
Correct.
Now, Mr. Freeman, speaking of South Carolina, also asked you yesterday about the 9.6 ROE the company settled upon in its most recent South Carolina rate case. You remember that line of questioning?
I do.
And he called that one, again, a data point that the commission should consider. So let's look at his exhibit. It's again in that big white book. And I believe it is Potential Cross Exhibit 7, which was then remarked as Hearing Exhibit 3.
I have it.
And this is the South Carolina settlement titled, quote, Comprehensive Settlement Agreement, as Mr. Freeman has helpfully highlighted, correct?
Correct.
Now, Mr. Freeman had you, and these are just excerpts, so it's the pages don't go sequentially. But if you go to the fourth page of the exhibit, Mr. Freeman has again helpfully highlighted the first sentence, or actually a part of the first sentence, in paragraph 51. And he says, or it says, the parties agree that this settlement agreement is reasonable, is in the public interest, is in accordance with law and regulatory policy. Correct?
Correct.
Now, the part that's not highlighted is the very next sentence, Dr. Morin, which reads, this settlement agreement in no way constitutes a waiver or acceptance of the position of any party or its affiliates in any current or future proceeding in South Carolina or any other jurisdiction, except as specifically provided otherwise previously herein. This settlement agreement does not establish any precedent with respect to the issues resolved herein and in no way precludes any party from advocating an alternative position in any current or future proceeding in South Carolina or any other jurisdiction. You see, is that what it says?
Yes.
And this settlement agreement, as indicated by its very title, was a comprehensive agreement agreed to by all parties in the proceeding on all issues in the proceeding, wasn't it?
Yes, it was.
So that included not only ROE, but cap structure, recovery of coal ash remediation costs, revenue requirements, various deferral requests, lots of different issues wrapped up into a single comprehensive settlement. Correct?
Yeah, I agree with that.
And it is very typical, Dr. Morin, in your experience, that when parties do wrap up all of their disagreements into a single comprehensive settlement, that they compromise for purposes of the settlement and the settlement only, strongly held positions simply to get a deal done.
That's correct.
And the compromise that the company and all of the interveners entered into, including the South Carolina Consumer Advocate, Department of Consumer Affairs, who had an ROE witness that recommended an ROE of 8.71%, correct?
Yes.
And you were actually the witness for the company in the South Carolina proceeding.
I was, yes.
And Mr. Walters, the public staff's ROE witness in this case, appeared as an ROE witness for the FEA DOD party in the South Carolina case. Did he
Yeah.
not?
Yes, he did.
And Mr. Freeman alluded yesterday to the fact that South Carolina has no risk mitigators in its rate-making construct. Do you recall that?
Yes.
But you don't recall Mr. Walters making any upward adjustment in his ROE recommendation on the flip side of the theory that the public staff has advanced in this case, that those mechanisms reduce risk, do you?
No, I do recall my rebuttal of Mr. Walters, and there was an enormous amount of common ground between he and I. We agreed on a lot of things. But to your point, there was no adjustment for presence or absence of any risk mitigators.
And you're not aware of any ROE witness in any of the company's prior North Carolina cases before the enactment of HB 951, making a recommendation to increase ROE due to lack of these risk mitigating, MYRP, PBR type factors, do you?
I am not aware.
Dr. Moore, let's take a look at some other data points that Mr. Freeman ignored. For example, the water company case that has been already marked as DEP Redirect, Morin Direct, and Rebuttal Exhibit 2. Awarded the water company, Carolina Water Service of North Carolina, an ROE of 9.8%.
That's correct.
Is there a difference in risk between a water utility and a vertically integrated electric utility?
Yes, there is considerable differences in risk. A water utility is basically akin to a pure electric distributor or a natural gas distributor. They are not afflicted with the risks associated with generation. So vertically integrated electric utilities are riskier than water utilities or pure distributors of electricity. And you can sort of see this in the data. If you look, for example, at the average beta of an electric utility, vertically integrated, it's about 0.9. That means in English, it's about 90% as risky as the overall market. Water utilities, on the other hand, have a beta of approximately 0.8. That's actually 0.79, but let's call it 0.8. So that difference of 0.10 in risk, in beta risk, can be translated into a return adjustment of about 60 basis points by multiplying 0.1 by the market risk premium of 6%. So the difference in risk from a market perspective would be somewhere in the order of 60 basis points. Another way of looking at it is to look at the authorized returns on water utilities versus the authorized returns on vertically integrated electric utilities over a long time period. And you'll see a difference typically of the order of 20 to 30 basis points. So not only the market, but also regulators have recognized these differences in risk.
Dr. Morin, let's switch over from Mr. Freeman. Don't want to leave out Mr. Neal's cross in the redirect. And he asked you about a DC Circuit opinion. We can pull it out if you need to. It's the NCJC et al. Potential Exhibit 40, but you said you were very familiar with it, so I don't think we need to pull it out. Regarding the risk premium method of estimating cost of equity capital, correct?
Right.
And in the water company case, DEP redirect, Morin direct, and rebuttal Exhibit 2. On page 44 of that opinion, the commission, in fact, endorsed the risk premium method, did it not?
Yes, it did.
Can you actually go to that page and
You'll have to help me on this one.
page 44. It's commission discussion.
I have it.
Okay.
I have it.
And let me pull up. Actually, it's in the conclusion of the commission discussion. And the first sentence reads, the commission concludes that witness Hinton's DCF result of 9%, and witness Hinton, Professor Morin, was the public staff's witness in that case. The commission concludes that witness Hinton's DCF results of 9%, witness Diascendis's DCF result of 10.12%, and witness Hinton's RPM, risk
premium
method result of 9.88%, which was corroborated using slightly different inputs by witness Diascendis, are credible, probative, and entitled to substantial weight. Is that what the commission said?
Yeah, I agree with the commission on this. In my experience with regulators, I spent a lot of time in workshops and brainstorming sessions with FERC, with other commissions all across the country. And I find that they are very receptive to the market risk premium method because it's so intuitive. You simply look at the difference between the returns on utility stocks and the returns on the bonds, and the difference is called a risk premium. And there's a lot of evidence on the magnitude of that risk premium. So it's a very intuitive, not as technical, if you wish, method, and it's not so academic, it's kind of intuitive. So it's a very popular method espoused by many, many commissions, including this one. So I was surprised that FERC negated that after spending 3 full days with the staff and the lawyers and talking about this method, and yet they sort of shoved it aside for some reason.
Now, Mr. Neal also asked you a number of questions, and I think Mr. Freeman did too, concerning projected interest rates in modeling. Could you just explain to us why it is actually appropriate to use projected interest rates in cost of capital modeling?
Okay. Financial models, DCF, CAPM, are prospective models. Investors make investment decisions on the basis of what they expect in the future. That's just common sense. If you're going to invest $1,000 in some company or some mutual fund, you're going to have some expectation about how the market will do or how that particular stock will do. So it stands to reason that investors price securities on the basis of expectations. That's a number one response. The number two, typically witnesses using the DCF model use projected analyst growth forecasts. People that use multi-stage DCF model use forecasts of GDP growth in the future. Even here in the NYRP, we're going to use projections for certain capital spending. So it's not unusual to use projected data for just about everything. So why not interest rates? Why are we discriminating about interest rates? So for both those reasons, I tend to use projected interest rates because that's what investors do, and it makes sense.
Now, Dr. Morin, in this case, in your direct testimony, you used in your CAPM modeling a risk-free rate based upon interest rate projections. And your methodology includes averaging projections of the 30-year Treasury bond from multiple sources. Is that right?
Correct.
Explain how the multiple source fits into your explanation as to the value of using projected interest rates.
Well, given the proliferation of all of these forecasts, Congressional Business Office, the White House, Bloomberg, the Energy Institute of America, the Blue Chip Economic Forecast, obviously there must be a value to investors since they're willing to pay for access to these forecasts. And so I tend to look at all of these forecasts and average them out. And in that testimony that you're citing, it was about 3.7% forecast of 30-year Treasury bonds. And here we are today at close to 3.9. So anyway, I think, again, financial models are prospective, forward-looking in nature. That's why I use forward rates.
So, Dr. Morin, you mentioned here we are today and we're close to 9, but if you would look at
Close to
if you would look at
3.9.
let's see, what's the I believe it's potential DEP potential redirect exhibit number 7. So the small book.
I have it.
Which lists on a monthly basis, going back to 1990, the 30-year Treasury bond yield.
Yes.
And just this past Monday, May 1st, the bond yield was 3.84%, correct?
Yes.
Which was actually more than your back in October projection of 3.7%.
Well, it was not my projection. It was the
The
consensus
consensus.
projection of various economic institutions.
So your 3.7 projection back in October, well, the consensus projection back in October, that ultimately yielded your original 10.2 ROE looks a bit on the conservative side, does it not?
It does.
Now, Dr. Morin, again, both Mr. Neal and Mr. Freeman spent a fair amount of time discussing with you yesterday the rising interest rate environment that we're in currently.
Yes, they did.
Is there a relationship between interest rates and investor required returns on equity?
Yes, there is. And the best way to answer that question is to go to my direct testimony. On page 9, there's a graph.
Dr. Morin, before we turn to your direct testimony, Mr. Mehta, did you want to mark that exhibit?
I certainly did,
Okay.
Chair Mitchell. And we will mark it. This was potential DEP exhibit, a redirect exhibit 7. And we will mark it as DEP redirect Morin direct and rebuttal exhibit 3.
3. All right, document will be so marked. All right, now we will turn to Dr. Morin's direct testimony.
Correct,
Okay.
page 9. And there's a a graph, a picture there right in the middle. And on the vertical axis, you have allowed returns on equity. On the horizontal, you have the yield on treasury bonds. And I think it's pretty obvious what's going on here. The higher the level of interest rates, the higher should be the allowed rate of returns. Because cost of equity has a kind of a risk-free part to it, which is the bond yields. So here we are in a rising interest rate environment, and it's not surprising that recently allowed returns have been inching upwards. That's unfortunate, but that is reality. Now, the relationship, if you want to be a little bit more exact, is something like this, commissioners. When interest rates go up 1%, regulators tend to increase the ROE by half of that, 0.5. That's called the elasticity or the sensitivity, if you wish. Conversely, when interest rates go down, commissions are reluctant to lower the ROE by the same full amount, so they will lower it by half of that. And that's been actually embedded in some of the commission's automatic ROE determinations. I hate to mention California here, but one of the good things that they do is they do away with all this ROE stuff. They only do it every 3 years. They have a huge triennial kind of ROE cost of capital hearing. But in the meanwhile, what they do is if interest rates go up 1%, they will increase ROE by half of that. Conversely, when interest rates go down, they will decrease the ROE by half of that. And that's embedded in the formula that they use. And I think it's a very good idea. You do away with all this beta and CAPM and DCF stuff and only worry about it once every 3 or 4 years. So that's the graph here that you see, and that's the relationship between allowed return and interest rates.
So Dr. Morin, let's talk about one other data point that Mr. Freeman missed from his examination yesterday. If you look at Exhibit 3, that's the 30-year bond exhibit, and go back to June 1st of 2021, which is when Mr. Freeman indicated that rates currently in effect went into effect. The 30-year Treasury bond yield as of June 1, 2021 was 2.16%, correct? Would be on the second.
Yes, I have it.
Or probably the third page of the exhibit. And as of May 1st, 2023, as we've noted, the yield has climbed to 3.84%, correct?
That is correct.
Which, and I'm no math whiz, but you are, Mr. Math Guy. That is a difference of 168 basis points?
Correct.
So, Dr. Morin, in your opinion, is the notion that the company's cost of equity capital has decreased since June 1, 2021, when the 30-year T-bond yield has increased by 168 basis points? Is that notion even remotely credible?
I don't believe it is. It's pretty obvious from the graph that we just discussed that the higher the level of interest rates, the higher is the allowed rate of return from past decisions.
And Dr. Morin, is the notion that the company's cost of equity capital has remained the same since June 1, 2021, when the T-bond yields have increased by 168 basis points? Is that notion credible?
No, I think they have increased. I do recall in many, many rate cases in which I've testified where I was in the 9.4, 9.5, 9.7, 9.8%. But since then, of course, interest rates are inching up, and now we're getting into double digits.
Chair Mitchell, that's all the questions I have.
All right, we will take questions from commissioners, beginning with Commissioner Brown-Bland. All right, Commissioner Glatfelter? Okay. Duffley? All right. Let's see. McKissick, I'm sorry, Hughes. you're up and then McKissick. Okay, and then,
Okay. Morning.
Good morning, sir.
I'd just like to understand a little bit more about this concept of baked in that you were talking about.
The concept of?
Baked in.
Okay, baked in. Yeah.
Baked
okay,
in. I think that's a formal modeling term,
All right.
if I'm not mistaken. So I understand that, with the proxy group having this mixture of utilities, each with their own different profile, and when they're all modeled together. Walk me through just a thought experiment. If we did not have a modernized rate-making construct in North Carolina, which, I think some would say we didn't have before 951, and everything else was the same, and you were asked to run your models. Could you explain if the outputs would be any different, or if they'd be identical to how they were now with this modernized rate structure? Does the question make sense?
Yeah, it does make a lot of sense. It's a very good question. In the absence of any of this PBR and these risk mitigators, I think, first of all, the monitoring agencies would have reacted negatively and perhaps maybe put the company on negative outlook. But in terms of the cost of equity, which is my responsibility, what I usually do is I come up with a range, let's say 9.5 to 10.5. And then if the utility, I consider it riskier than average, because of the absence of any risk mitigators, I would say to the commission, you should seriously consider setting the ROE on the upper half of the range. Conversely, if you're less risky than average, set an ROE in the lower part of the range. So that's how I would handle this.
So is that to say that your final presentation and recommendations with the model would have been different if we didn't have this modernization?
Yes, you're absolutely right. Because, in the absence of risk mitigators, you will be obviously exposed to all of these risks. And the whole idea of risk mitigators is to offset all the new risks that have appeared in the last few years.
So would have that difference that you're talking about, would have that been outputs of any of your models, or would have that been something, to lack of a better term, be sort of an outside of model adjustment on your part?
I think it would have been reflected in the model, particularly in the cost of debt. If you were to look at the yield on the company's bonds versus the average yield on BAA electric utility bonds, you might have seen a premium there because of the absence of risk mitigators. That would be one way of looking at it.
And that would be on debt, but I'm talking about the cost of equity models that we've spent so much time with. Those models, the Duke would still be in the same proxy group. So the proxy group wouldn't change. The characteristics of Duke of having this modernized rate-making construct or not, that doesn't change how you put things into the model. I mean, does
The only evidence one would see would be in the stock price of Duke Energy.
Okay.
What you would do is compare the evolution of Duke Energy stock price on a graph versus the S&P Utility Index, for example. And you probably would see an underperformance on the part of Duke Energy versus the average electric utility. That would be one way I would look at it. And the other way, of course, is to pick an ROE in the upper half of the range.
Okay. So I understand that's something that you would pick on the upper half of the range, but would the outputs of any of the financial models that gave you the range, would those have been different if Duke was operating under the same rate construct?
Now, you wouldn't see it in the model because, unfortunately, Duke Energy Progress is an operating utility. It does not have any stock price or market data, so you couldn't see it that way. The only way you could see it is through the Duke Energy, a parent company stock price, and through maybe an increase in the cost of debt versus what the other utilities are yielding in their bonds. So that's the only way I could, two ways that I can probably see it. But I see where you're coming from. How would the models change if you didn't have, this?
Yes,
Yeah.
I
Good
appreciate
question.
it. So I mean, is it fair to say that your recommendations probably would have been different if we didn't have this modernized rate-making construct, but you would have gotten to those different recommendations using your professional expertise, looking at you'd be looking at the same outputs, you'd get the same range, but you would use your professional experience to present possibly a higher number to us.
That's correct.
Okay, thank
Yeah.
you.
Good point.
Okay. Commissioner Kimmerer.
Good morning, Dr. Moran.
Good morning, man.
I just have a couple of questions. The first is just for clarification. Your testimony talks about a recommended ROE of 10.4%, and then I think your testimony yesterday was 10.2%.
That's correct.
Is the 10.2 your current recommendation?
It's 10.2 because we have witnessed a slight flattening of the interest rate in recent weeks.
Okay, thank you for that clarification. And then I have a question about how you would determine the ROE among consideration of the 23 companies that you considered in the proxy group. And I think on cross-examination, you said that not all risk mitigation measures are created equally, is my recollection from yesterday.
You're correct.
And in North Carolina, we now potentially have a number of risk mitigation measures, and it appears to me that North Carolina would have the totality of these risk mitigation measures that you mentioned, like revenue decoupling, riders, adjustment clauses, MYRP, and PPRs. And so for the proxy group, would there be an analysis to consider less risk for North Carolina in comparison to the other companies in the proxy group, because North Carolina has the totality of the risk mitigation measures? Does that question make sense?
Yeah, it makes a lot of sense, actually. You could look at, of course, the devil's in the details.
Right.
But if you look at the specifics, for example, of the MYRP or the PDR, you would look at, for example, the sharing mechanism. How does it compare to the other sharing mechanisms that other companies have? Is it 50-50? Is it 100 basis points? Do you share on the downside as well as the upside? And how does it measure up against the other sharing mechanisms? And that's very hard to quantify in terms of basis points, but that certainly could be done qualitatively. And also, I think where you're going with this is because of the totality, the amount of risk mitigators. Does that compare with the other companies? That would be a factor as well. But my own opinion is that it's quite comparable to the other PBR plans that we have, that you're considering, I should say.
So potentially, it could result in a lower ROE, but I think your testimony is that you believe that is comparable, even though North Carolina has the totality of the risk mitigation measures.
It does have a totality, but some of the features are, the absence of a downside sharing, for example, is of concern. But again, it's in all the details, which is hard to quantify in terms of basis points. But I'd say I applaud the whole idea of you considering all of these mechanisms, and to get away from traditional rate base, which I call cost plus regulation, and move towards an incentive based type of situation, and make the utility accountable for its performance. I really applaud all that. I've written a whole chapter on all that stuff, which I would urge you to consider.
Thank you. And then I just have a question or two about the settlement agreement in South Carolina. And I do recognize that that for any settlement agreement, there's clearly give and take. But the settlement agreement, I think, was filed in, looks like January the 12th of 2023 with the ROE for DEP of 9.6%. And then, of course, here we're DEP, and you are recommending ROE of 10.2%. And so what I'm trying to understand is, since South Carolina, DEP in South Carolina now has a lower ROE than what's been recommended in North Carolina, have there been any changes in the rating outlook for DEP due to that 9.6% ROE?
Not yet.
Okay. And what is the time period if there were to be any changes? When would that occur? Is that something that's already been considered and there's no changes, or is that something that would be considered at some time in the future?
Bond rating agencies review the status of their ratings on a quarterly basis. So I would think in the next, in this quarter, I think you will see the impact. And I'm sure they will say that 9.6%, whereas the average authorized ROE for vertically integrated electrics is slightly above 9.7 right now. That might be of concern to the bond rating agencies.
Okay.
But this whole business of authorized returns, sure, investors look at them and consider them as one of the many factors they look at. But if regulators simply look at what the other commissions are doing, it's sort of like looking in multiple mirror images of one another, and nothing would ever change.
Mm-hmm.
So I think this commission has a mind of its own and should make up its own mind.
Certainly, they're two separate applications. And last question, this may ask for too much speculation, but are you anticipating that there will be any change for the rating outlook for DEP due to
do financial asset correlations increase in times of crisis? So these questions are going to go to to beta values. But sort of as an initial question, in your opinion or in your experience, do financial asset correlations increase in times of crisis?
I'm not sure I understand the question. I assume financial assets, you mean stocks and
Yes.
bonds and
Stocks,
other
bonds, yes.
securities. Do they move in tandem? The answer is usually yes.
That is my question.
yeah.
So answer that question.
The one negative correlation is when interest rates go up, the stock market typically goes down because people switch out of the stock market into more favorable, more attractive interest rates. So that's a sort of a negative movement between the two.
Okay.
Everything else sort of moves together. All the stocks, the utility stocks, they all kind of move with the market. The tide is lifting all boats, so to speak. But interest rates is counter to stock market movements.
Okay. You've testified that beta for utilities is around 0.9. Is that right? 0.89 or 0.9?
That's correct.
Okay. Just want to make sure my understanding is clear
Yeah.
there. And you've also testified that the beta is elevated relative to where the beta for utilities has been in the past.
Yes, there's a graph in my direct testimony which shows a steady increase in beta risk.
Okay. Is it your view or is it your opinion that this elevated beta is associated with this brief period of turmoil that results from the pandemic and the associated consequences of the pandemic on the economy at large?
Okay.
Or are we in a more or is this a more permanent move in the beta?
Yeah, that's a good question. You're basically saying maybe betas are high because of COVID. And the answer is not anymore. Perhaps it used to be years ago. I think what investors are looking at is the challenges and the risks imposed by the movement towards the decarbonized society, the movement towards renewables and so forth. These pose all a bunch of risks that I discussed earlier. So I think betas are going to be high for quite a while until we see more evidence of how utilities can tackle these challenges.
Okay. In prior times of crisis, have utility betas gone high and then reverted back to more historical level?
No, I didn't. I looked at that in the prior black swan events, I call them, like when the Fed pursued quantitative easing, QE, and injected tons of money to try to jack up the economy. I didn't see betas going up or anything like that. No, I think the high betas that we see today is a reflection of the higher risks faced by utilities.
Okay. And how long do you think we will be in this higher risk period?
Until we see more evidence of how successful the utilities will be in answering those challenges, I think for a while.
Okay.
It's not going to be short term.
Okay. All right, dividend yield. How do you select the date on which you collect spot prices for purposes of calculating dividend yield?
It's whenever I do the work. I don't have any, choice. I don't pick a date where the stock prices are high or low. Whenever I have to deliver the first draft is the date that I pick. Really.
Okay, got it.
And I don't have any problem with somebody using stock prices going back to answer the questions that were asked earlier by staff. Going back 10 days or something, it's fine with me. But I don't like to violate market efficiency. I don't like to use stale data.
Okay. All right. E-CAPM adjustment. Is it your testimony or is it your opinion that the E-CAPM adjustment is still necessary even with adjusted betas?
Yes, there's two different adjustments. Number one, the beta is the beta. It's adjusted for its trend over time. And the E-CAPM has nothing to do with beta. It has to do with what I call a vertical or rate of return adjustment. And the reason for that is because everybody's tested the CAPM empirically. There's been so many articles and dissertations and so forth on the CAPM. And inevitably, the evidence strongly suggests that low beta stocks are basically underpriced by the CAPM and conversely for high beta stocks. So the E-CAPM is an attempt to correct for that. And one can wonder, why is it that the CAPM understates the return for low beta stocks? Probably because low beta stocks are usually high dividend yield type of stocks, which from a tax point of view is taxed like ordinary income, whereas high beta stocks are usually growth stocks, on which you don't pay taxes until you realize the gain. So there may be a tax here that's at work that causes this flattening of the slope between risk and return, so to speak. So the quick answer to your question, these are two different phenomena. The beta is one thing, adjustment for bloom over time, and the vertical adjustment is for the inability of the CAPM to fully explain the trade-off between risk and return.
Okay. Okay. All right. Yesterday, I believe we heard you testify that there is a market risk premium of 6%. Do you remember your testimony to that effect?
No, I use, okay, the empirical evidence. That's quite a question, actually. The market risk premium is the most researched number in all of the social sciences. There's been literally dozens, if not hundreds, of studies about that. And me and many other authors have summarized this evidence, and the evidence suggests that the market risk premium is between 6% and 8%.
Okay.
I did the review of the literature. Brady and Myers did a review of this considerable literature, and somewhere between 6 and 8%. Here, in this particular case, I use 7.
Okay. So you've used 7 for purposes of your analysis in this. Okay. Okay. All right. Let me see if there are any other questions from commissioners. All right. Questions on commissioners' questions. We will start this side of the room.
Do you want to go last?
No questions from CUCI.
Thank you, Chair Mitchell. Or do you have? Seeing none others, David Neal, NCJC et al. Briefly, Dr. Moore, in response to Commissioner Kimmeright's question about your revised ROE recommendation of 10.2%, was it your intention to file supplemental testimony with your revised recommendation?
No.
And in relation to questions from Commissioner Duffley and Commissioner Kimmerright about potential rating agencies' reaction to an ROE decision coming out of South Carolina, I believe your response was you didn't know when there would be such a response.
All right.
If I could turn your attention back to NCJC et al. Forgotten my litany. NCJC et al. Cross-examination Morin direct rebuttal exhibit 12, which was DEP's response to NCJC data request 16-1. It was at tab 42 of the book, but I think that's enough description to get you there. Are you there?
I think so.
This is again, we discussed the Arizona public service
Oh, yeah.
decision. And in your response, you indicated the decision of the commission in that case that we talked about was November 9th, 2021. Do you recall that?
Yes.
And you indicated here that the downgrade from A- to BBB+ was reported in an article from Moody's on November 17th, 2021. Do you see that?
Yes.
Okay. So in that instance, there was an relatively immediate reaction from the rating agencies. You would agree?
Yes.
And we have not seen such a reaction from the South Carolina decision to date. Isn't that
No.
right?
That's correct.
Okay.
That's because the Arizona decision was so draconian.
I understand.
So extreme.
Your opinion on that. Chair Mitchell asked you some questions about the risk-free rate and your from your direct at 3.7 and your supplemental to 4.3. I just want to clarify one thing. My understanding is that in your supplemental testimony, you only relied on the blue chip economic indicators forecast for that 4.3 number. Isn't that right?
That's correct, but I also looked at the others and they corroborated the 4.3.
So the methodology that you discussed at some length in your direct testimony about the different sources that you looked at and considered was absent in the supplemental. You just went with blue chip economic indicators in your supplemental.
Yes, in order to be consistent with the other witnesses that use blue chip.
And finally, there was another question from Chair Mitchell about elevated betas. And your response relates to value lines betas, correct?
Yes, sir.
And you would acknowledge that there are other sources of betas.
Yes, sir.
For example, S&P Global Market Intelligence.
Yes, they publish betas. They're not widely used by investors, but they do publish them.
Yahoo Finance publishes betas, correct?
Oh, you don't want to use Yahoo Finance betas. They use daily returns. It's just no
I understand that.
variability in the data. And
I understand you prefer value line, but you would agree that Zacks also publishes betas.
yes, they have the same, they commit the same sins as Yahoo Finance. They use daily returns, which you can't do.
No further questions.
Good morning again, Dr. Moran.
Morning
This
to
is
you.
Will Freeman for the public staff. I just had one topic I wanted to follow up with you on. Commissioner Hughes asked, if the mathematical modeling and sort of did a thought experiment, what would you do for DEP if we didn't have these favorable or modern laws like we do in North Carolina? But don't we have a model of DEP that you did in South Carolina, which doesn't have these favorable laws, and you still reach the same results that you did here?
That's correct.
Okay, thank you. I don't have any more questions.
Dr. Moran, I also wanted to follow up on Commissioner Hughes's question. And if I understood the question and your answer, it was essentially that you as a ROE expert typically come up with a range of modeling results, and that you, in terms of your ultimate opinion, in this case, the ultimate opinion ended up with an average of the range of results from the models. You might tend to go towards the higher end of the range using your judgment if you were in a situation in which there was a complete absence of risk mitigation measures in the jurisdiction in question. And that was the thought experiment, correct?
Yes.
But we now have modernized risk mitigation adjustments, in addition to fuel clauses and the things that we used to have before. It would not be appropriate in that circumstance where we are today in North Carolina to provide a downward adjustment in otherwise applicable ROE, because those risk mitigation factors are already, to use the phrase that Commissioner Hughes used and Mr. Freeman used yesterday, baked in to the numbers.
Correct.
That's all that I have.
We have a few more questions up here and we will go back around. Mr. Duffley.
Hi, I had a follow-up with respect to Mr. Freeman's question, because he asked about North Carolina and South Carolina, and that you've made the same ROE recommendation in North Carolina and South Carolina. But we were talking about the regulatory mechanisms, but isn't there a different regulatory structure? Because North Carolina has decarbonization goals that South Carolina does not have. Can you speak to that a little bit?
I think that the I'm going to be nice to you now. And I think the North Carolina Commission is more clairvoyant, more up to date, more modern, so to speak, and a bit ahead of the game vis-a-vis South Carolina. I would view the South Carolina Commission as riskier in a sense than the North Carolina Commission. And in the bond rating agency evaluations of jurisdictions, North Carolina is regarded as supportive. And that's good. Good for ratepayers, good for the company. Whereas South Carolina, I'm not sure is viewed with the same degree of esteem as the North Carolina Commission. And that's in part due to what we're talking about today, PBR and mechanisms and so forth. Is that answering your question?
I was actually getting to the fact that when you're looking at risk,
Yeah.
because North Carolina has this decarbonization law, and we're making more of a transition than South Carolina, is there more potential risk in North Carolina because of this energy transition?
I think so, because of the challenges that the company and other utilities face to implement the decarbonized society. I think I described earlier all the risks, engineering types of risks, the demand risk, the impact of the distributed generation, and the impact of new technology appearing on the horizon. We just don't know enough about that yet. So there are some risks to be reckoned with.
And we may have one more question.
I'll ask the question. One of the exhibits, it's the South Carolina Comprehensive Settlement Agreement that the parties filed in the South Carolina docket. It's public staff's proposed cross-examination exhibit number 7, and we've marked it as public staff cross-examination, more indirect rebuttal, exhibit number 3. So look behind tab number, public staff tab 7.
I'm in the wrong book. Public staff potential cross exhibit number
7.
7.
Yes.
I have it.
Okay. We've gotten an excerpt here from a comprehensive settlement agreement that the parties filed. The filing information on the side of the excerpt indicates that there were 34 pages. I'd ask the company to file as a late filed exhibit the entire settlement agreement.
Yeah, we'd be glad to do that.
Okay, to the extent that it's not already in the record.
I don't believe so. I think this was the only reference to the South Carolina settlement.
The question I have for you, Dr. Moran, just because you've been asked questions about this, and I can ask Mr. Newland or someone else about this. If you look at the paragraph number 7, where the settlement is set forth, the terms of the settlement regarding ROE and cap structure. There are reference to riders and mitigation measures contemplated in the settlement agreement.
Yes.
So do you know what those riders and mitigation measures are?
No, I do not.
Okay.
Ask a company witness. I
Okay.
think.
But presumably, okay, I will save my question then.
Chair Mitchell, probably the right witness would be Ms. Bateman,
Okay, I will ask Ms. Bateman then.
who would probably also be the right witness to ask in terms of comparison between and among states regarding risk mitigation measures, because that's part of her testimony.
Okay, I will reserve the questions for Ms. Bateman then. All right, let me see if go ahead, Commissioner Brundtland.
So just to sum it up, your recommendation for South Carolina and North Carolina coming to the same point, are you telling this commission that even with the risk mitigators we have, that essentially you view both states for whatever different reasons as being equally risky?
So that's a tough question. I think the regulatory risk is slightly higher in South Carolina, but I don't think I can quantify it. So,
Thank you.
Okay, questions on these specific commissioner questions?
Kyle Smith for DOD FEA. And can I approach the witness? Or may I approach the witness?
You may.
And I'd like you to go to DOD FEA potential cross exhibit 5, which was previously marked for the hearing as DOD FEA cross examination, more indirect and rebuttal exhibit 3. And this is going to the questions related to increased risks from the energy transition in North Carolina versus South Carolina that Commissioner Duffley asked. Does this document reflect investor views on potential benefits to the energy transition in North Carolina to carbon-free generation sources?
I'm not sure I'm looking at the right exhibit here. Is it entitled Summary of the Direct Testimony of Ms.
No, I'm sorry, the potential cross exhibits, you may be looking at a direct exhibit. It should be, it's the Fidelity Utilities Sector.
I have it.
Okay. And the title of the document is Utilities Sector. The sector is writing the transition to renewables, correct?
Yes.
So I re-asked the question, is this a reflection of investor views on the transition from the energy transition to carbon-free generation sources?
Yes, and the key sentences here is the word could. Electric utilities are moving towards decarbonization, could be particular beneficiaries of the shift to renewables. Again, it's fraught with risk.
But you've testified multiple times that investors are looking to what's going to happen in the future, and they're relying on projections on making their investments, correct?
Correct.
And I want to take you to page 3 of that document. And the second paragraph, I just ask you if you could read it. And under utilities could remain in favor, where it starts with but again.
As we look to 2023, the economy and markets may continue to face the onslaught of headwinds they've encountered this year, including rising interest rates, persistently high inflation, political unrest, and slowing growth worldwide. Amid this environment, utilities could remain in favor for their defensive characteristics, which include durable cash flows and dividends. And again, the key word being could.
Yes, now could you keep reading?
But again, the long-term story could be even more compelling. Utilities are at the epicenter of the transition to renewable energy sources. Generating power from renewable resources is now more economical than generating power from fossil fuels, thanks to technology improvements and increased economies of scale among renewables. Meanwhile, consumers, businesses, governments are actively seeking to reduce their carbon footprints And these primary factors are propelling accelerated earnings growth for utilities, with average earnings growth in the sector recently rising to its highest levels in decades. So I agree that the growth prospects of utilities are probably higher, but they're a lot riskier.
Okay. And I'd also like you to look at the section directly underneath that for potential beneficiaries. And it discussed that companies that are investing to expand the renewable energy fleets could benefit. Do you agree with that view?
Yes, I do, actually.
And it also says there could be advantages for companies focused on nuclear energy. Would Duke Energy Progress fall into that category?
Yes, it could.
Okay. All right. Thank you.
Mr. Freeman, questions?
No questions. Thank you.
All right. Mr. Meta.
Chair Mitchell, just one follow-up with respect to South Carolina.
Okay.
Dr. Moran, the South Carolina retail portion of DEP is probably less than 10% of the company, and the North Carolina retail portion is probably on the order of 65 to 70% of the company. Does that have any impact on the manner in which rating agencies or the immediacy by which rating agencies might react to
Yeah, I
these?
think they would give a lot more time and lip service and analysis to a much larger utility than a smaller one. That would make sense to me.
Nothing further.
All right, with that, then we have come to the end of Dr. Moran's testimony. I will take motions.
It's been a pleasure appearing before your commission.
Thank you very much for your testimony, sir.
Exhibit.
All right.
We have moving exhibits now.
Is it appropriate to move exhibits at this time?
Yes, it is.
EODFEA would move EODFEA cross-examination, Moran direct and rebuttal exhibits 1 through 3.
All right, hearing no objection to your motion, it is allowed.
Chair Mitchell, I would also move in, this is David Neal for NCJC et al. Move into the record NCJC et al. Cross-examination, Moran direct rebuttal exhibits 1 through 13.
All right, Mr. Neal, your motion is allowed.
Chair, I would move public staff cross-examination, Moran direct and rebuttal exhibits 1 through 19 into the record.
All right, Mr. Freeman, I have 18. I don't have 19.
I had the map behind tab 13 as the 19th exhibit. But that's my, I'm going.
What is your proposed number on the map?
I had two maps. One was at what I have in my notes is 19 was the map behind tab 13. And if I didn't, I thought I identified it, but if not, I'd ask Lee to do that.
All right, well, we will, let me see if there's an objection or a response from the company about this.
Chair Mitchell, I have 19.
Okay,
also.
all right, well, then that's just my mistake, Mr. Freeman, I apologize. All right, then hearing no objections, Mr. Freeman, your exhibits, public staff exhibits 1 through 19 will be admitted.
Thank you.
All right, Mr. Meta.
Chair Mitchell, I would move the admission of Dr. Moran's exhibits attached to his direct, supplemental, and rebuttal testimony as marked in the exhibits themselves.
All right, hearing no objection to that motion, it will be allowed.
And then I would further move, Chair Mitchell, the introduction into evidence of DEP redirect Moran direct and rebuttal exhibits 1, 2, and 3.
All right, that motion is allowed. All right, Dr. Moran, you may step down. All right, company may call its next witness.
Chair Mitchell, the company would call Carl Newland to the stand.
All right, good morning, Mr. Newland.
Okay. Good morning.
All right, raise your right hand, left hand on the Bible. Do you swear testimony you're about to give should be the truth, the whole truth, and nothing but the truth, so help you God? All right, you may proceed, Mr. Mehta.
Thank you, Chair Mitchell. Mr. Newland, would you please state your name and business address for the record?
It's Carl W. Newland, 525 South Tryon Street, Charlotte, North Carolina, 28202.
And by whom are you employed and in what capacity?
Duke Energy or Duke Energy Business Services. I'm the Senior Vice President of Corporate Development, and I'm the Treasurer.
Thank you, Mr. Newland. Chair Mitchell, just as a reminder, Mr. Newland is here for his direct testimony. He will be coming back for his rebuttal testimony. And we all understand that there's a fuzzy line between the two, but we'll try to do the best we can. But Mr. Newland, on October 6th, 2022, did you pre-file or cause to be pre-filed in docket number E2 sub 1300 direct testimony consisting of 17 pages?
Yes.
Are there any corrections you need to make to your pre-filed direct testimony?
None that I'm aware of.
And if I were to ask you the same questions today under oath, would your answers be the same as those set forth in that pre-filed direct testimony?
Yes.
Chair Mitchell, I move that Mr. Newland's pre-filed testimony in docket number E2, direct testimony in docket number E2 sub 1300, as previously described, be entered into the record in this proceeding and be copied into the record as if given orally from the stand.
All right, the direct testimony for Mr. Newland filed in this docket on October 6th, 2022, consisting of 17 pages, will be copied into the record as if given orally from the stand.
Mr. Newland, did you also prepare a summary of your direct testimony around the 2nd of May?
Yes, I did.
And the summary, Chair Mitchell, was pre-filed on May 2nd and provided to the commission and all parties. And I ask that it too be included in the record as if read orally from the stand.
All right, the summary of witness Newland's direct testimony will be copied into the record as if given orally from the stand.
Chair Mitchell, the witness is now available for cross-examination and questions from the commission.
All right, Ms. Kress, you're up.
Chair Mitchell, Sigford does not have any questions for the direct testimony of Mr. Newland. Thank you.
All right, CUCA? All right. Okay. League of Municipalities? DOD-FEA? Okay, Mr. Neal?
Apologies, I also decided to not ask questions on direct, but save them for a rebuttal.
Okay. All right, Mr. Freeman?
I'll be brief and then I'll save the rest for rebuttal and we can stop by 11, hopefully. One of the things you're proposing in your direct is to move from 52 to 53% equity. Is that right?
That's correct.
Would you agree with me that equity is more expensive than debt?
I would agree that it is more expensive.
More than twice.
I guess it depends ultimately on what the ROE is set at, but it is more expensive. Equity capital is more expensive than debt capital.
It's going to be around 4 and the ROE SALT is 9 or 10. So more than twice.
I don't disagree with the math, but ultimately it depends on what the ROE decision is.
Does that mean, let's say that we kept everything else the same as the order from April 16, 2021, everything else the same, except debt went to 47 and equity went to 53. without doing math, would that increase or decrease ratepayers' bills?
Well, we have had, I mean, as a company, we have had historically operating under the existing structure. We've been falling below some of our Moody's targets in terms of holding the rating. So the impetus for trying to get a little bit of pad on the equity side was to improve our standing with Moody's to hold the rating, which ultimately will keep the cost of debt down and accrue to the benefit of the customers.
And thank you for that. I guess I was asking a more general question. What's the impact of equity going up and debt going down if nothing else changes?
In terms of the rate or in terms of the percentage?
In terms of a customer's bill, isn't it a slight increase? Not much, but a slight increase,
If
right?
the equity component goes up and the debt component goes down, it should be a slight increase.
Okay, I just wanted to make sure I understood the concept. If you have the public staff's notebook, I believe it's near you.
Mr. Newland, it's one of those great big white books. Unless Dr. Moran walked off with it.
Cross-examination, cross-ex exhibits?
If it's public staff.
Yeah.
Yeah.
Would you turn to tab 6 with me?
Okay.
This is an excerpt, and I think I'm not going to file excerpts anymore, but this is a 330-page document. It's a 10K. If you'll look with me at page, pardon, let me propose to mark this. I apologize. As public staff cross-examination, Newland Direct, Exhibit 1.
All right, the document will be so marked.
And if you'll look with me at page 202.
So 59 of the K?
Yes. Thank you.
Yeah, okay.
And again, this is part of a 300 and some
Yeah.
page
Yeah,
document.
it's our 10K. Yeah.
Duke Energy, which is the ultimate parent of DEP, its current equity structure is 41 and its current debt structure is 59%. Is that correct?
Yes, that's what the 10K says.
And that's also accurate.
Yeah, I mean, that's a consolidated look, right? That's the holding company look. That's not the individual utility of the company we're talking about today.
And if we compare Duke Energy Progress's debt to Duke Energy Corporation's debt, it looks to me like DEP has a better debt ranking than its parent.
That's true. It does. Most of the utility operating companies, in fact, all of them do better ratings than the holding company.
Is the funds from operation to debt ratio confidential?
For trailing, it's not.
I just don't want to.
For trailing, it's not.
If it's in the 10K is a public document.
I just want to make sure I don't elicit confidential testimony by accident from you.
Okay.
Do you know, or if you know and are allowed to say, can you tell us the funds from operations to debt ratio?
For the consolidated or for DEP?
DEP,
For DEP,
approximately.
last year, because of the elevated fuel costs, it was about 18%. Our downgrade threshold was 20%. It's been raised to 21%. FFO to debt is a measure of cash flow to debt. And the rating agencies use that as a key metric to determine what our ratings will be. So last year, because of the elevated fuel costs, it was 18.4%. If you adjust for the fuel and say that's kind of a one-time thing, it was 20.8%. And then in 2021, it was 20.6%. So, the rating agencies look for us to historically be between 20 and 22% on that FFO to debt range. And recently, just in April, last month, they raised that downgrade threshold to 21% on the FFO to debt. And I can talk about some of the reasons why they have raised that cut line or that downgrade threshold for DEP.
Thank you. Commissioners, I have a few more questions, but I'm glad that they're not terribly related to his direct, and I'm glad to ask them in his rebuttal. we can be done with him before 11 if that's important to the commission.
All right, well, if the questions don't relate to his direct, then why don't you hold them for rebuttal? If they do, you can ask them.
Okay, they do.
They relate to his direct?
I mean, his direct and rebuttal kind of talk to each other. So if we wanted to move it, I'm glad to, but I'm also glad to ask them that.
Go ahead and ask. It's
Okay. I think you'd agree with me that there's no plans to obtain funds from equity in the foreseeable future. Is that correct?
From Duke Energy Corp or DEP?
I'm sorry. Let me start over. I think that, why don't you tell me the approximate estimate of some of the capital expenditures that Duke Energy Progress is going to be making?
Yeah, so DEP is during this, growth cycle, this build cycle that we have in the state, due to the carbon plan. It's a cash flow negative company, which is not unusual for utility, especially in growth mode. And so its sources of funds will necessarily be debt issuance. It will be retained earnings from not sending as much dividends up to the holding company or its equity investor as is typically needed. And it can be equity funds as needed, equity injections as needed from the holding company.
And that's $13.5 billion?
Correct. It's about $2.5 billion a year is the capital, plus there's a maturity in there. That's right.
And that $13.5 billion is not going to be raised by, well, DEP is not issuing stock. Is Duke Energy the parent corporation? It's not going to be issuing equity. So the source of the funds for DEP is going to be debt and retained earnings.
At DEP, that's correct. If it does need an equity injection, it would obtain that from the holding company.
Okay.
And we've said publicly that the holding company is not planning to issue common stock until 2027 at the earliest.
So that's why it's important to look at some of these debt ratings, is because a lot of this is going to be financed with debt. Correct.
Correct. Absolutely.
Okay. What, if you'll tell me two things, and I'll just I think you touched on this, but I just want to give you a chance to tell us. Why does it matter going from 52 to 53% equity, and why should it or shouldn't it happen?
So our rationale for going to 53% equity is really based on three reasons. The first two relate to Moody's, which I think is the more stringent of the rating agencies that review us. So if you look at the Moody's scorecard, which is the way they set up the rankings for the company's ratings for us and everyone else, they ascribe a certain weighting to the debt capital structure, the debt and equity component. And for that A rating category where DEP is right now, it's a 40 to 48% debt rate or component of the capital structure. So as you can see where we are today, we're kind of right at the edge of that A rating at 48.52. And so given a lot of the pressures that we're facing around fuel costs, higher interest rates, the large capital spend, I'm looking to have a little bit of cushion in there on the equity padding. And so we're trying to move it just, 1 percentage point up to 53.47. That 47 clearly being within the 40 to 48% within the Moody's scorecard. I mentioned, but the second reason is, I mentioned before the FFO to debt as a primary ratio that the rating agencies look at. And again, that's cash flow to debt. That's really their primary metric they look at. And they've asked us to be 20 to 22% to hold the rating. As I alluded to, they just recently, last month, raised that downgrade threshold from 20, which is where it had been, up to 21%. As I also testified, our ratio the last 2 years has been below 21%. So we are below that downgrade threshold now. And an additional equity in the capital structure and an ROE as requested would help get us above that 21% and maintain that. And the last reason on the 53.47 is, this gets into some of the rebuttal exhibits, but, I looked at a number of comparable companies, utilities, 60 of them across the country, and their average equity component was 53.3%. And as we look to raise capital in the marketplace, It matters what the utilities are up to the holding company. It matters what the debt ratings are at each one of the companies. For those three reasons and all those exogenous factors I talked about, that was the rationale for seeking the 5347 capital structure.
Would you turn with me to tab 109?
In the same book?
Yes. Which I would propose to mark public staff cross-examination, Newland Direct Exhibit 2.
All right, we looking at a Moody's? Okay. The document, let's see, will be identified as public staff, cross-examination, Newland Direct, exhibit number 2.
Mr. Newland, are you there?
I'm there.
You referenced a moment ago when you were talking through the 3 points. So sort of a Moody's scorecard. I can't remember the exact terminology.
Yeah, because
Is this it?
I guess I'm used to seeing a summarized version of it.
Are you looking for the weights?
Yes, yeah, that one.
Mr. Freeman, I think that the document that Mr. Newland is referring to is probably the credit opinion that has a summary embedded in it. But we could use either one.
Okay, it discusses the scorecard beginning page 9 of that Moody's document. So I think this does reference the scorecard. I'm accustomed to looking at the summary from the credit opinion.
Okay. And it gives certain weight to various factors, regulatory, the ratios, et cetera.
Correct.
Yeah, I thought this was. If we went through this, this is sort of the longer version of the
Yeah.
summary that you're discussing.
I think that's right. Yeah.
Okay, that's what I understand. If I want to look at this and the summary Moody's, that's where I could see the various weights that Moody's assigns to various items.
Yeah, that's right. I think they do put the weights here in page 9 through 13. Yeah.
And Moody's doesn't use, what are they, it's hang on, what do they call that?
Yeah, their FFO to debt it's kind of shorthand that we use. It's pre-working capital, cash flow to debt. It's essentially the same.
What's their ratio? What are they looking at before you are worried about a downgrade?
21% is where they
Is
just
Moody's.
moved us to. Yeah, they did that in April of 23.
Okay,
Yeah.
what's S&P's threshold?
For DE, they do a family rating methodology. I would have to look. They have a range. It's typically a little softer than Moody's, but I'd have to check the range for S&P. Moody's is definitely strict rating agency.
Okay. If you will look at the document behind tab 19, which has been marked in Dr. Morin's testimony, and should I remark it again?
No, but let's refer to it as we've
The
marked
document
it.
behind tab 19 is the S&P Global Ratings for Duke Energy Progress,
Yeah.
which I actually drew from your website, but you recognize this document, I expect.
And we've identified it for purposes of the record as public staff cross-examination, more and direct rebuttal, exhibit 14. Is that correct, Mr. Freeman?
Uh,
Just want to make sure we're looking at the same document.
14, yes, 14.
Okay, thank you.
So Moran Exhibit 14, S&P Global up in the upper left corner. Are you at that document?
I'm at that tab, yes.
If you'll turn with me to page 2 of 12, you see the downside scenario?
Yes.
Is that what you were reading? I didn't mean to rush you.
No? I was flipping ahead. But I'm on that page 2 now.
I see a 12% number here.
Right, that's for the consolidated, that's for the holding company.
Okay.
Yeah, so the holding company, with all of its subsidiaries rolled underneath, has a different FFO to debt metric for its ratings.
Is it
If it's
confident?
12%, it's 12% at S&P and it's 13% at Moody's.
Is that number confidential?
Trailing, it's not.
Can you tell me the trailing number for,
The holding company.
yes, please.
So again, we have to adjust for fuel because of the elevated fuel prices that we had. So last year, 2022, our FFO to debt consolidated was 11.3, so well below the downgrade threshold. Adjusted for the fuel, it's at 13%, which is right at Moody's cut line. 13%, sir, at adjusted for fuel at Moody's.
Okay. I think I'm close to being done. If you'll give me one moment. Thank you. I don't have any more questions.
All right, redirect.
Chair Mitchell, it's 10:57. I can go or wait till we come back after lunch.
How many questions do you have?
It's more than 3 minutes worth.
Okay, well then let's hold until after the lunch break. We will come back and resume with redirect of the witness. And we will be back on the record at 1 o'clock. So let's go off the record, please. Let's go back on the record, please. And we are, Mr. Meadow, with you, redirect examination of your witness.
I thank the Chair Mitchell. Mr. Newland, in response, I think, to one of Mr. Freeman's questions, which was essentially, what's the difference between 52 and 53 on the equity pad? You mentioned that there were 3 reasons. 2 of them had to do with Moody's. And one of the Moody's reasons that you mentioned was the raising of the downgrade threshold by Moody's. Very recent raising, correct?
Correct.
And if you would, Mr. Newland, take a look at what has been previously marked as DEP potential redirect exhibit number 9.
Okay, I have it.
And Chair Mitchell, I'd like to go ahead and mark the potential exhibit 9 as DEP redirect Newland direct exhibit 1, which is a mouthful.
All right, the document will be marked as DEP redirect Newland direct exhibit 1.
And Mr. Newland, this is a Moody's publication dated 24th of April, 2023, so just a couple of weeks ago.
That's correct.
And it has a very innocuous headline. It says, Rating Action, Moody's affirms Duke Energy and subsidiary ratings, correct?
Yes.
So Moody's is not saying, in the headline at least, we are doing something with the ratings of DEP.
That's correct.
But Mr. Newland, if you go back to the last page of that exhibit, I want you to read with me some of the finer print that's behind the headlines. And you see the section that's headed factors that could lead to a downgrade.
Yes.
And what Moody's says there is downward rating action could be considered if there were to be a deterioration in the credit supportiveness of the regulatory relationships at Duke's subsidiaries that could result in a reduction of cash flow. That's their first sentence, correct?
Yes.
And then a material increase in operating or capital expenditures that is not able to be recovered on a timely basis, or an increase in leverage leading to weaker credit metrics could also put downward pressure on the ratings, correct?
Yes.
Now, what is it that Moody's is saying in the next paragraph as it relates to DEP?
Yes, this gets to the raising of the downgrade threshold for the FFO to debt metric, or as they define it, CFO pre-working capital to debt. And so if a company is below your threshold metric for a period of time, that to be 18 months, 2 years or so, then the likelihood of ratings action increases. They would typically do a negative outlook first, and then if it wasn't resolved within 12 months, they would move fully to a downgrade. And so in this paragraph, they cite that Duke Energy Progress, the metric is if it's below 21%, up from 20% previously. So that's what I was getting at in my comments earlier, that they've raised that downgrade threshold from 20% up to 21%.
And Mr. Newland, I think maybe we can illustrate the impact of this raising of the downgrade threshold. If we look at DEP potential redirect exhibit 12.
Okay.
And Chair Mitchell, I'd like to go ahead and mark this as DEP redirect Newland direct Exhibit 2.
All right, Mr. Meta, just making sure we're looking at the same document. It's a credit opinion dated March 24th, 2022 from Moody's.
Correct.
Okay, so we'll mark the document DEP redirect, Newland Direct Exhibit number 2.
And Mr. Newland, is Exhibit 2 there, credit opinion dated 24th of March, 2022 for DEP issued by Moody's?
You're asking, is that what it is?
Yeah.
Yes, that's what it is.
And in fact, I think this is the same document that Mr. Freeman was working with Professor Morin about yesterday, and I may have used it earlier today. But I'd like for you to focus, Mr. Newland, on the graph that's on page 2 of Moody's March of 2022 credit opinion. And just tell us what this graph portrays.
Yeah, so this is the aforementioned metric, the FFO to debt metric over time, so 2017 to 2021. And they break apart their cash flow metric in green in the color copy, and then the total debt amount in the light blue bar. And you can see the ratio over time. And in 2021, it was 20.6%. And you can see, and it was 18.1% in 2020. And so to get to the point earlier about the downgrade threshold originally being at 20%, in 2021, we were above that. 2019, we were above that. But now they've raised it to 21%, in all of those historical periods, except for 2019, we would have been below that downgrade threshold on this metric.
And if this obviously doesn't capture 2022.
Correct.
But if you could just remind us what the 2022 FFO to debt.
Yes, I believe that was, so again, with the fuel adjustments, just because of the run up in fuel costs, they typically ran them with and without the fuel costs in the numerator and the denominator. It was 18.4% on a calculated basis. So all the fuel costs in there and the debt to support that in there. So 18.4%. And then as adjusted, I believe it was 20.8, I believe.
So, is it fair to say, Mr. Newland, from the standpoint or viewpoint of Moody's, the company is already operating below their raised downgrade threshold?
Yes, I would agree with that.
No further questions.
All right, questions from commissioners. We'll start with Brown Bland. Okay, Gladfelter. Okay. Definitely. Hughes. McKissick. Go ahead.
In the preceding exhibit that was just introduced, I think it was the Newland 1 in redirect. Now it's exhibit number 9. There was language in there related to the Duke entity out in Kentucky.
Yes.
Where it was the credit matrix were pretty discouraging. It was low. What was going on out in Kentucky?
Well, in Kentucky, so they did take a negative outlook posture on our utility in Kentucky. That's what the report describes. In Kentucky, we're currently before their commission on a rate case, seeking rate relief, and hopefully we'll be successful in that case and be able to resolve the negative outlook.
And what was contributing to the negative credit matrix? And it looked like it got down to a bond rating to B or so, BAA.
Yeah, they're currently at a BAA1, I believe, and they're on a negative outlook, which would take them to a BAA2 if they're downgraded. So kind of a solid triple B type metric. I believe the issues there are, rates being somewhat stale, and so we don't have the cash flow that you expect from refreshed rates, and the debt component has been a little high with the expenditures in Kentucky.
So that's what's been contributing to it.
I believe so, yes.
All right. And of course, here in North Carolina, we don't have those issues or problems in terms of the history of increases in our state.
I'm sorry, say that again.
In terms of North Carolina, there have been reasonable rate increases in the past in return that's been allowed.
Yes. Yes, correct.
And I take it that has not been the case in Kentucky?
I'm not familiar with all the history.
You don't know the history.
Specifically in Kentucky, but clearly the agency is taking, an outlook change as a real shot across the bow, saying they will do a downgrade if things don't improve in the next, call it 12 months or so.
As I recall, in Kentucky, you guys generate power mostly with coal, don't you?
Yeah, we have one major facility that is a coal facility operating in that state,
So,
serving that state.
so obviously there's no carbon plan that they've adopted or anything
They do
similar
not have a
comparable.
carbon plan. No, they do not.
And probably no discussion of it.
Again, I'm not familiar with all the details in that particular case. I'm not the witness in that case.
I understand. I was just curious. I mean, it was in the same exhibit, so it caught
Yeah,
my attention.
I think traditionally, I think it's fair to say Kentucky has not been as progressive in terms of seeking carbon reductions as North Carolina.
Seems like a lot of that coal comes from Kentucky.
Yes, it does.
All right. Thank you.
Yes, sir.
All right, Mr. Newland, just a few for you. Can you help me understand the 20% threshold? Why is it set at 20%? When was it set at 20%? And then my next question that you can answer is, why did they increase it to 21?
Yeah, so I'm not sure when the original downgrade threshold was set at 20%, but if you look at the rating scorecard that I referenced earlier, where they go through quantitative and qualitative factors to look at what a company should be rated, a range of 20 to 22% is a Baa1 rating, so a high triple B rating. So think about it that way. And that's currently where DEP is categorized on that particular metric. And I talked earlier about the debt to cap metric and how it's a single A metric. And within their scorecard, they put all these factors together and weight them to come out with our current A rating that we have at DEP. And so I think just given the historical performance and their assessment, they felt that 20 to 22% was the right range to be in. And certainly we've operated under that for quite a while. I'm speculating a little bit, but on the reason that they raised the downgrade threshold, I think you can point to the overall concern from Moody's about the status of the electric industry. So in November of 22, they put the entire sector on negative outlook. So all electric utilities, they put the sector, not individual companies, but the sector on negative outlook. And they cited a number of pressing factors on electric utility companies: higher fuel costs, higher interest rates, large capital spends, inflation. They cited all these factors as just being a generic pressure on the industry. And I don't think it's a coincidence then that several months later, they raised the downgrade threshold for us, and I believe DEC as well, based on that metric. So I think it reflects a concern by Moody's about the credit quality of the industry going forward.
Are you aware of whether the threshold was increased for any of your peer utilities?
I don't know.
Okay.
They did say to us, because obviously we call them and ask them about this, is they did say they were looking to align the metrics of the Duke utilities with other companies in the sector. They didn't really give an explanation for that, as often they won't give specific explanations as to the actions they take, but they did mention that.
Okay. You mentioned a general downgrade issued in, I think you said December of 2022?
For the second negative outlook on the sector.
Understood. Was that, where was that action memorialized?
It's in a Moody's report in November of 22.
Is that report in the record, to your knowledge?
It's a potential exhibit. I can certainly put it in.
Let's do that. And let's have that done, Mr. Mehta.
Very good. Chair Mitchell, I would point you to DEP potential redirect exhibit number 11.
All right, let's mark that document as DEP redirect, Newland Direct Exhibit 3. Mr. Newland, do you have that document in front of you?
I can certainly get it.
It was potential 11.
I do.
Okay, is this the document you were thinking of?
Yes.
Okay, and it's remind or tell me again what point this document supports that you've made.
So on November 10th, they put out a report moving to negative outlook on the sector of regulated electric and gas utilities. And they cited a number of items that DEP and a lot of other companies are facing, that being higher fuel costs, inflation, large capital spending, et cetera. And they noted that financial metrics are already under pressure with little cushion entering 2023. And I believe the rating agencies do this only to let investors know, debt investors know that there could be downgrades coming, which obviously could affect the prices. I believe my contention is that this was a little bit of concern by Moody's about the status of the industry. And so they put this piece out first, and then they've gone to the individual companies and made some changes, DEP being an example of a change in the downgrade threshold on that financial metric.
Okay, so the change in the downgrade threshold followed this generic expression of concern.
Sequentially. Yeah.
Okay, got it. Okay. Any additional questions from commissioners? All right, questions on commissioners' questions? This side of the room, Mr. Freeman?
Oh, I don't think so.
Okay. All right, Mr. Mehta.
Just in terms of the sequence, Mr. Newland, did Moody's action to raise the downgrade threshold also follow in time from the order issued by the South Carolina Commission?
It would have followed in time. That's correct. I believe the South Carolina settlement was January, and this came out in April 23.
Nothing further, Chair Mitchell.
All right. With that, then I will accept, Mr. Newland, your testimony on your direct cross-examination on your direct testimony has come to an end. I'll accept motions from council.
Thank you, Commissioner. The public staff moves that public staff cross-examination, Newland Direct Exhibits 1 and 2 be entered into the record.
All right, hearing no objection to your motion, it will be allowed.
Chair Mitchell, I would also move into the record DEP redirect Newland Direct Exhibits 1, 2, and 3.
All right, hearing no objection, your motion will be allowed.
Thank you, Chair Mitchell. And Mr. Newland will be back. But
All right, you may step down, sir. Thank you very much. All right, Duke, let's call your next witness.
Jim. Thank you, Chair Mitchell. This time, Duke Energy Progress would call to the stand Brent Guyton and Dan Malley, and we'll be just adjusting chairs here if you give us one moment.
All right.
Excuse me, Chair Mitchell, if I could make a procedural motion, if this is the appropriate time for that.
You may.
So all parties have indicated that they agreed, this is Andrea Bonvecchio on behalf of the Sierra Club. All parties have indicated that they agree to waive cross-examination of Sierra Club witness Michael Goggin. If there are no objections and if the commission does not have any questions for him, we would therefore move that the commission excuse Mr. Goggin from attending this evidentiary hearing.
All right, I'll check with my colleague. Questions for the witness? Anyone have questions for the witness? All right, your motion is allowed. Thank you.
Thank you.
All right, good afternoon, gentlemen. If you would, reach over, place left hand on the Bible, raise your right hands. You swear the testimony you're about to give shall be the truth, the whole truth, and nothing but the truth. All right. You swear the testimony you're about to give shall be the truth, the whole truth, and nothing but the truth, so help you God.
I do.
All right. All right, you may proceed.
Chair Mitchell, for the record, I'm Jim Jeffries with the law firm of McGuire Woods, and I'll be handling Mr. Guyton and Mr. Malley today on behalf of the applicant, Duke Energy Progress.
All right, good afternoon, Mr. Jeffries.
Thank you. Mr. Guyton, we'll start with you. Could you state your name and business address for the record, please?
Brent Guyton, 555A Brevard Road, Asheville, North Carolina.
And where do you work, Mr. Guyton?
I'm sorry.
Who do you work for?
Oh, Duke Energy Carolinas.
Okay. And what's your position with Duke Energy Carolinas?
I'm the Director of Asset Management doing distribution planning.
And what are your responsibilities in that position?
Planning for all the Carolinas to build a safe and reliable grid, resilient and prepare for the carbon transition.
Thank you. Are you the same Brent Guyton that pre-filed direct testimony on October 6, 2022, consisting of 55 pages and Guyton direct exhibits 1 through 10?
Yes, I am.
And did you also cause to be pre-filed in the docket supplemental testimony on February 13th, 2023, consisting of 10 pages and Guyton supplemental exhibits 1 through 4?
Yes, I did.
And finally, are you the same Brent Guyton that pre-filed rebuttal testimony on April 14th, 2023, consisting of 61 pages and Guyton rebuttal exhibits 1 through 8?
I am.
Was that testimony and were those exhibits prepared by you or at your directions?
They were.
Do you have any corrections to your pre-file testimony and exhibits?
I do not.
Mr. Guyton, if I ask you the same questions that are set forth in your pre-file testimonies while you're on the stand today, would your answers be the same as are reflected in your pre-file testimony?
They would.
All right, thank you. Chair Mitchell, the DEP would request that Mr. Guyton's pre-filed direct, supplemental, and rebuttal testimonies be entered into the record as if given orally from the stand.
All right, the direct testimony of witness Guyton filed on October 6th, 2022 in this docket consisting of 55 pages will be copied into the record as if given orally from the stand. Exhibits will be marked for identification as they were when pre-filed. Supplemental testimony filed on February 13th, 2023 consisting of 10 pages will be copied into the record as if given orally from the stand. Exhibits to the supplemental testimony will be marked for identification as they were when pre-filed. Rebuttal testimony filed on April 14th, 2023, consisting of 61 pages, will be copied into the record as if given orally from the stand. Exhibits will be marked for identification as they were when pre-filed.
Thank you, Chair Mitchell. Mr. Malley, could you state your name and business address, please?
Daniel Malley, 411 Fayetteville Street, Raleigh, North Carolina.
And who do you work for, Mr. Malley?
I work for Duke Energy Progress.
Actually, Mr. Jeffries, before we transition to your next witness, let's move Mr. Guyton's testimony summary.
I was going to handle them together, but I'm happy to do them separately. So, Madam Chair, the summaries of Mr. Guyton's pre-filed testimonies have been filed with the commission as ordered, and DEP would move them into the record.
All right, testimony summaries for the witness will be copied in the record as if given orally from the stand.
Thank you. Mr. Malley, what's your position at Duke?
I'm the General Manager of Transmission Engineering for DEP.
And what are your responsibilities in that position?
Responsibilities include design and engineering of the transmission grid, including transmission lines and substations.
And you're the same Dan Malley that pre-filed direct testimony in this proceeding on October 6th, 2022, consisting of 41 pages.
That's correct.
And attached to that testimony were Malley direct exhibits 1 through 4?
Yes.
Correct. And you also pre-filed supplemental testimony on February 13th, 2023, consisting of 11 pages and Malley supplemental exhibits 1 through 4.
Yes.
And finally, pre-filed rebuttal testimony on April 14, 2023, consisting of 48 pages, and attached thereto were Malley rebuttal exhibits 1 through 5. Is that correct?
Correct.
All right. And was that testimony and were those exhibits prepared by you or under your direction?
Yes, they were.
Do you have any corrections to your pre-filed testimony or exhibits?
I do not.
Mr. Malley, if I ask you the same questions that are set forth in your pre-filed testimonies while you were on the stand today, would your answers be the same as is reflected in those testimonies?
Yes, they would be.
Chair Mitchell, DEP would request that Mr. Malley's pre-filed direct, supplemental, and rebuttal testimonies be entered into the record as if given orally from the stand.
All right, the direct testimony of witness Malley consisting of 41 pages filed in this docket on October 16th, 2022 will be copied into the record as if given orally from the stand. 4 exhibits to that testimony will be marked for identification as they were when pre-filed. Supplemental testimony filed by the witness on February 13th, 2023, consisting of 11 pages will be copied into the record as if given orally from the stand. 4 exhibits to that testimony will be marked for identification as they were when pre-filed. Rebuttal testimony filed by the witness on April 14th, 2023, consisting of 48 pages will be copied into the record as if given orally from the stand. The 5 exhibits to that testimony will be marked for identification as they were when pre-filed. Rebuttal testimony includes confidential information. The record will reflect confidential information as necessary. So I'd ask parties to ensure that it does.
Thank you, Chair Mitchell. As was the case with Mr. Guyton, Mr. Malley's testimony summaries have been prepared and filed with the clerk, and DEP would request that they be entered into the record as if given orally from the stand.
All right, that motion is allowed.
And with that, Mr. Malley, Mr. Guyton are available for cross-examination questions by the commission.
All right, we've got Attorney General's office.
Good afternoon, gentlemen. Tyrell Moore with the Attorney General's office. I believe all my questions are going to be for you, Mr. Malley, so you can relax, Mr. Guyton. Mr. Malley, on pages 44 to 45 of your rebuttal testimony, you stated that it was inappropriate for AGO witness Burgess to recommend that the commission require DEP to conduct a study on the cost and benefits of grid enhancing technologies. I'm going to refer to those as GETs. Do you recall that?
I do.
And you stated that was because the commission already considered GETs in the carbon plan docket. Do you recall?
I do.
The commission has a responsibility in this proceeding to determine whether the company's costs are reasonable and prudent, correct?
Correct.
And part of that determination is evaluating whether there were more cost-effective alternatives, correct?
Correct.
And some of the costs that the company is proposing to recover in this proceeding during the multi-year rate period relate to transmission system investments, correct?
That is true.
Approximately $1.5 billion.
Correct.
I would like you to take a look at what has been marked as AGO Potential Cross Exhibit 1. I believe it's in this white binder right in front of you. Chair Mitchell, I would ask that this exhibit be marked as AGO Cross-Examination, Guyton, Malley, Direct, and Rebuttal Exhibit 1.
All right, Mr. Moore, just want to make sure we're looking at the same document. Is this unlocking the queue with grid enhancing technologies?
Correct.
Okay. Let's see. Document will be marked as AGO, Cross, Guyton, Malley, Direct, Rebuttal, Exhibit 1.
Chair Mitchell, could we have just a moment? We're having trouble locating the
You may.
AGO's cross exhibits.
God, this is a little.
Excuse me, which exhibit was it again?
Potential Exhibit 1.
Okay.
And I have an extra set if that would be helpful.
Sure.
Yeah. We have.
Do you recall Mr. Burgess discussing this study in his testimony?
Not specifically, no.
Okay.
I'm not familiar with this study.
I believe on pages 11 and 12 of Mr. Burgess's testimony, he cited some of the key findings of this study. Do you recall that?
I don't recall the specifics.
Okay. Do you have Mr. Burgess's testimony with you today?
I do. Would you like me to refer to it?
Yes, if you would turn to page 11.
Okay.
And it's at line 6. Mr. Burgess discusses this study. Do you see that?
I do see line 6.
Do you recall this now that you've had a chance to review?
I do recall reading this testimony.
Okay. If you'll turn back to the exhibit. Will you take a look at page 10 of that exhibit? And this study found that in the SPP, more than 175 million production cost savings could be achieved through the implementation of GETS. Do you recall this?
No, I don't recall this. I'm not familiar with this study, nor have I read this study.
Okay. If Duke had the ability to use GETS to achieve similar cost savings, don't you think that would be a relevant consideration for the commission?
As filed in rebuttal testimony, under the carbon plan, we did consider and discuss the use of grid enhancing technologies. It's our position that the multi-rate plan is not a vehicle to establish policy for how transmission investments should be determined. And more specifically, you talk about production costs. That's really not an issue relevant to transmission. As an operational witness, our job is to essentially take the electrons from the generation resources and get them to the substation. So production costs, generation costs, that's not part of my area of expertise.
You would agree that this proceeding, the commission is looking at specific costs?
They're looking at the specific cost of, in my case, transmission investments under the forward-looking multi-year rate plan. That's correct.
Deep.
Yes. Is that better? Yeah. Thank you.
DEP did not formally study GETS for the projects included in the MYRP, did it?
So specifically related to the multi-year rate plan, the way we've established the projects included in there, multiple different avenues, our transmission planning or capacity and customer planning projects. Those are all established in accordance with the North Carolina Transmission Planning Collaborative, or it's our regional transmission process. Various other projects included are under our asset management or end-of-life asset replacement avenues. So we have studied and evaluated all the projects that are included in multi-year rate plan.
Where in the record can the commission look to see those evaluations?
Which evaluations?
The ones you just described.
Okay. Yeah, so we've included very detailed analysis of all the various ways we've evaluated projects to be included. Our program summaries, those are one of the exhibits. I could go through various exhibits. We've included cost benefit analysis, which of course is a form of study. That's one input that we use to select the appropriate investments.
GETS can be used to defer transmission investments, correct?
I'm not familiar in detail with GETS. Again, I knew we did have some discussion on GETS in the carbon plan, as we have not included GETS specifically in our 3-year multi-year rate plan. I don't have detailed knowledge of them.
Will you turn back to Mr. Burgess's testimony and take a look at Exhibit 2 to that testimony?
Yes, I will. Okay, I have Exhibit 2.
And this was a data request sent by the AGO to the companies. Have you seen this data request?
Yes, I have seen this data request.
And on the second page of that data request response, the first full paragraph, I'm going to read, DEP considered but did not formally study GETs for the projects included in the MYRP. Did I read that correctly?
Correct.
And then further down in that response, you state, or this response states, that dynamic line ratings are short-term corrective actions to allow time to implement permanent infrastructure improvements. Did I read that correctly?
You did.
And then in the final paragraph, advanced power flow control devices can delay but don't eliminate traditional upgrades. Did I read that correct?
You did.
Where can the commission look in the record to determine which projects could be delayed and for how long?
So from the perspective of, projects that can be delayed, projects that need to be implemented now, we feel there's prudent justification, and we've provided supporting evidence across various different platforms through this case on why we stand behind our investments. So we don't believe there's any investments that are included in our multi-year rate plan that can be delayed. We feel it's prudent to proceed with all of the investments.
No further questions.
All right. Mr. Neal, NCJC? Oh, I'm sorry. Go ahead.
It's all good. Good morning, actually, good afternoon. Minash Magruder on behalf of NCJC et al. My cross-examination questions will be directed to Mr. Guyton. Do you have the NCJC exhibit notebook in front of you?
Do I have the, what? I'm sorry.
It's the exhibit notebook for NCJC.
Yes.
Perfect. Okay. Let's start by talking about stakeholder engagement as it relates to distribution planning. As part of its distribution planning, DEP solicits stakeholder feedback.
That's correct.
And stakeholder feedback, you'd agree, is an important factor, of course, not the only factor in helping to ensure that DEP's investments maximize ratepayer benefits and minimize costs.
We value feedback. We consider all the feedback that we get from stakeholders.
Sure. Would you agree that absent sort of commission directives, how that stakeholder sort of engagement takes place is something that's solely within DEP's discretion?
I'm not sure if it's solely within DEP's discretion, but we engage in stakeholder engagement, really at the ISOP level, and distribution planning is a subsection of that.
I guess to maybe kind of ask the question a little bit more directly and specifically, if DEP, for instance, wanted to, let's say, do something with respect to distribution system planning, ultimately, whatever it decides to do, unless it hears otherwise from the commission, would be a decision that DEP makes.
Yes, the responsibility of Duke Energy is to do our distribution planning, and we are accountable and responsible to the commission for our actions in that way.
Okay. And sort of absent, I mean, similar kind of train of inquiry, absent commission directives, whether DEP explains its decisions regarding stakeholder feedback, that's a decision that's also within DEP's discretion.
I believe so. We are the only party that this commission holds accountable and responsible for distribution planning.
And again, absent commission directives, it's within DEP's discretion to include additional topics for discussion in its stakeholder processes.
Subject check, I would think so.
Yeah. And again, not to bear too much on this point, but again, absent commission directives, whether DEP actually incorporates stakeholder feedback into its planning is a decision that's solely within its discretion.
Yes, as I stated a moment ago, we are the only party that's ultimately accountable to this commission for distribution planning actions. That's correct.
Thanks. Can you turn to tab 12 in that NCJC exhibit notebook?
Okay, I'm there.
All right, Mr. Guyton, this is DEP's response to item 3.4 from our second data request to DEP. Is that what you're seeing?
No, I'm seeing an Excel document, Excel Energy.
Do you have the Chair Mitchell?
I do not have your notebook. I've got the testimony.
And that's what I wanted to confirm. Chair Mitchell, may I approach? Yeah, that'd be great.
And what was the tab again?
It was tab 12.
I'm there.
All right. And I'll ask that question again, Mr. Guyton. This is, I believe, DEP's response to item 3.4 from NCJC et al.'s third data request, correct?
Mr. McAvoy, we need to mark this document if you're going to seek to introduce it.
Yeah, no, sorry,
okay.
I can do that.
Let's get that done.
All right. So Chair Mitchell, at this time, I'd ask that this exhibit be marked as NCJC et al. Cross-examination, Guyton Maley, direct rebuttal, exhibit 1.
All right, it will be so marked.
And you're there now, right?
Yes, I am.
All right. Could you go to the second page of that document and you should see there's a request sort of portion of that.
Correct.
Could you read that out?
Please describe any changes the company has made to the substance or content of its grid improvement plan as a result of stakeholder feedback since the last general rate case.
All right, great. And can you read out the last sentence of DEP's response? And that's the sentence that starts with, the company has heard.
The company has heard and considered feedback provided by stakeholders in formulating their GIP and MYRP proposals that cannot point to a specific incorporation of stakeholder feedback into a specific program.
All right, thank you. Moving on, and you mentioned this already, you talked about ISOP, so we'll kind of move and transition there. So you would agree that one component of DEP's sort of stakeholder strategy with respect to ISOP is its ISOP stakeholder sort of engagements or workshops.
That's correct.
And ISOP, which is an acronym for Integrated Systems Operation Planning, and I'm quoting here from your direct testimony, it's page 23, line 15, is a comprehensive planning process using new tools to integrate generation, load, transmission, and distribution together to more effectively, efficiently, and economically deal with an increasingly diverse set of energy factors.
Correct.
And so I'm paraphrasing here. ISOP is sort of this holistic planning process that informs DEP and DEC's distribution planning strategy across the Carolinas.
That is correct.
Okay. And given your current role with Duke Energy, which you've been in since 2020, if I recall, you're generally familiar with these ISOP stakeholder engagements.
Yes, and specifically, the distribution portion is the advanced distribution planning portion underneath that ISOP umbrella.
Yeah, and thank you for that clarification. Would you agree that since July 27th, 2021, Duke Energy has only held one ISOP stakeholder meeting?
I do not know the number, subject to check.
So subject to check, would you agree?
Yes.
Okay. And subject to check, that stakeholder meeting, the one that was held since July 27th, would you agree that was held February 16th, 2023?
Subject to check.
And subject to check, would you agree that that February 16th stakeholder meeting occurred after a 2022 DEP South Carolina rate case settlement?
Correct.
All right, let's talk about the category of spending under Duke's grid modernization plans. Per your supplemental testimony you filed, and I'm referring here to, I think, pages 2 through 3 of that supplemental testimony. I'll just wait until you're there.
What was the page again in supplemental?
It's like pages 2 through 3.
I'm there.
Okay. DEP is now proposing $2 billion in distribution MYRP projects, and that represents, relative to your direct testimony that you filed, I think, October 6th, it's a net reduction of about $226.7 million across the distribution MYRP projects. Is that right?
That is correct.
Okay. And with respect to those distribution MYRP projects, DEP's proposed spending kind of falls under three big sort of umbrellas. We've got substation and line, retail and system projects, and hazard tree removal. Is that right?
There is also in the distribution portion, there are facilities projects and some other
Right.
things, but those are three of the major categories.
Yeah, definitely. There's advanced, as you mentioned, so perfect. So under that substation and line project sort of umbrella, those projects are further subdivided into 12 program areas, right?
That is correct.
And those, I'm just for reference and for context, those 12 program areas are self-optimizing grid, voltage regulation and management, distribution automation, capacity, hardening and resiliency laterals, hardening and resiliency storm, hardening and resiliency public interference, equipment, retrofit, long duration interruptions, targeted undergrounding, distribution integrity, and hazard tree removal.
Correct.
Yeah. And in addition, as you mentioned, you're proposing a variety of other projects, including the advanced distribution management system as a non-distribution MYRP project.
Correct.
Okay. Now, the company has obviously proposed grid modernization programs and spending in the past, correct?
Yes, we have.
In fact, the company proposed a grid modernization program referred to as Power Forward in docket E2 sub 1142. Isn't that right?
Subject to check. I was not involved in that.
Okay. Are you generally familiar with sort of the Power Forward proposal?
I've heard the term, but was not involved in any of the planning and for that.
Okay. Subject to check. Would you read that Power Forward, when it was proposed, at least in the sub at 1142 docket, the company did not seek cost recovery for Power Forward in that docket, subject to check.
Subject check, I do not know.
Okay. Mr. Guy, can you turn to tab 2 in your exhibit notebook?
Exhibit 2?
Yeah, tab 2, exhibit 2.
I'm there.
Okay. And you can see, obviously, and apologies for this typo, I think the way it appears in the index is incorrect.
I'm sorry, you asking about your notebook?
It's my notebook, sorry. And I'll try and specify in the future just which notebook. Just for clarity, in most instances, I'm going to be probably referring to NCJC's notebook as opposed to whatever other notebook that you've got up there.
Understood.
And just let me know when you're there.
So this is potential cross exhibit 2 is what you're referring to?
Yeah.
I'm there.
All right. And so again, apologies for the typo, but as you can see, hopefully from looking at this order, and it's actually excerpts from the order, there are references to DEP. So this is, which subject to check, this is from the sub 1142 docket.
I'm not familiar with it. I don't know, but subject to check.
Okay. As Chair Mitchell, at this time, I'd ask this exhibit be marked as NCJC et al. Cross-examination, Guyton Maley direct rebuttal exhibit 2. And
all right, the document, let's see, before we mark it,
Yeah.
just want to make sure my first page begins with while the company, is that correct?
I believe that should be accurate. Let me just double check in my notebook, but I think that's right.
Okay.
Yeah.
Okay, the document will be so marked then.
Chair Mitchell, we have no objection to entering commission orders, which is what this appears to be, an excerpt from the commission order, but we would ask that the entire order be entered because from what's present here, I don't think anyone can tell what order this came from or what docket and it puts Mr. Guyton, I believe, at a little bit of a disadvantage, not even being able to determine what docket this order was issued in.
Chair Mitchell, I mean, one of the things I was going to sort of ask, sort of following, marking it, was to ask if the commission would take judicial notice of its order in the 2 sub 1142 docket.
All right, let's do that, but why don't you cite the order for me so that the court reporter gets it into the record accurately?
Definitely. And so this is the commission's order, I believe, accepting. Actually, let me pull this up on my laptop just so I'm not giving you the incorrect citation. Sorry, bear with me. Jeff, oops, I just got my sheet about this. Sorry, so this, I guess the order citation is order accepting stipulation, deciding contested issues, and granting partial rate, granting partial rate increase, docket number E2 sub 1142.
Date of issuance.
I believe it's June 22nd, 2018, if I have that right. Sorry. Sorry, I had that date wrong. It's February 23rd, 2018. I believe the other one is June 22nd. I had that pulled up. Okay.
Right, the commission will take judicial notice of the order as requested by counsel for NCJC et al.
Sorry about that. And Mr. Guyton, seeing as how you're now oriented to the document, can you turn to the list of projects towards the bottom of page 98 of that order, and the PDF page is page 4, and just let me know when you're there.
I'm looking at page 98.
Okay. Can you see that there's a list again of projects that are listed down there?
Yes, I do.
Can you read those out loud, please?
Targeted underground transmission lines, distribution H&R or hardening and resiliency, transmission, self-optimizing grid, advanced metering infrastructure, enterprise system upgrades.
Great, thanks. Let's actually move to, yeah. All right, so as I mentioned, obviously the commission, the company didn't see cost recovery in the power forward, I guess, docket in the 27 general rate case, but it did seek it did seek cost recovery in the DEC docket instead, subject to check.
I do not know. I'm not familiar with that case at all. I'm sorry.
Can you turn to tab 1 of your exhibit notebook?
You said 1?
Yeah.
I'm there.
Okay, Commission, Chair Mitchell, at this time, NCJC et al. Would request that Commission take judicial notice of its order in the E7 sub 1146 docket. And I believe I'll get you the order citation court reporter. And the specific citation for that is order accepting stipulation, deciding contested issues, and granting partial rate increase, docket number E7 sub 1146, June 22nd, 2018.
Commission will take judicial notice of the order as requested by counsel for NCJC.
Yeah, apologies for the delay. Mr. Guyton, I'm going to draw your attention to the second full paragraph on page 128, and that should be the second page of the PDF. Specifically, it's the paragraph that starts with DEC witness Simpson, and just let me know when you're there.
I'm there.
Can you read that full sentence that begins with DEC witness Simpson?
DEC witness Simpson described generally the programs comprising power forward, including 1, targeted undergrounding, 2, distribution system hardening and resiliency, 3, self-optimizing grid technology, 4, transmission system improvements, 5, advanced metering infrastructure or AMI, 6, communication network upgrades, and 7, advanced enterprise systems. According to Witness Simpson, these programs will primarily focus on projects that accomplish the following goals: improve the reliability and hardiness of the system while making it smarter, build a foundation for customer-focused innovation and new technologies, comply with the prescriptive federal transmission reliability and security standards, address maintenance requirements for aging assets, further integrate and optimize intermittent distributed renewable energy generation, and address physical and cybersecurity, worsening weather, customer disruptions, and wear and tear on equipment.
Thanks. And just based off the list of names and projects, would you agree that there's obviously some overlap with respect to the projects between DEP and DEC? So still talking about the power forward proceedings in both.
I'm not sure, but I would assume so.
Subject to check.
Subject to check.
Okay. Great. Now, DEP's proposed MYRP distribution projects in this proceeding, those include targeted undergrounding, distribution system hardening, and self-optimizing grid, correct?
It does.
Now, the company, and you should be familiar with this, company did seek approval for a grid improvement plan in its last general rate case in the E-2 sub 1219 docket, correct?
That is correct.
And as you note on pages 24 and 25 of your pre-filed direct testimony, the grid improvement plan that was originally proposed in that docket, it seeks to address the same megatrends as the company's proposed MYRP distribution projects in this proceeding.
Yes, it does. Those trends continue today.
Now, the commission in that sub 1219 docket ultimately approved the public staff and DEP's second partial stipulation, along with other stipulations, including one between DEP, North Carolina Justice Center, and North Carolina Sustainable Energy Association. Isn't that right?
Subject to check. I'm not familiar with the details of that settlement.
Yeah. Those stipulations covered a smaller list of projects than DEP's original sort of grid improvement proposal that it filed in that proceeding.
That is correct.
And those stipulations, they permitted deferral counting up to 400 million for those projects.
Subject to check. That number sounds familiar.
Turning your attention to Guyton Direct Exhibit 1, so from your direct testimony, specifically page 4. And just let me know when you're there.
I'm at Guyton's Direct Exhibit 1.
Yeah, and page 4.
I'm there.
And you see there's a table, it's table 1, I think it's the caption.
Yes, I do.
It's got a list of sort of the GIP plan and actual capital expenditures.
Correct.
And you can see the sort of GIP programs listed. There's self-optimizing grid, integrated volt VAR, ESDR to CBR conversion, going on, obviously.
Correct.
All right. Mr. Guyton, can I have you turn, so this is the NCJC notebook, so not the other notebook that you might have in front of you. Can I have you turn to tab 78 in that NCJC notebook?
You said 7-8?
78, and it's in our NCJC notebook.
I'm there.
Chairman Mitchell, at this time, I'd ask that this exhibit be marked as NCJC et al. Cross-examination, Guyton Maley, direct rebuttal exhibit. I think we're at 3.
All right, just to confirm, we're looking at the same document. This is a response to a data request
That's right.
dated February 2023.
Yeah,
Okay.
that's right.
All right, the document will be marked as NCJC et al. Cross-examination, Guyton Maley, direct rebuttal, exhibit number 3.
Okay. And Mr. Guyton, let me know, you're there at that tab, right?
I'm there.
Can you read the request that's listed on that data request response?
So the request is, please clarify what portion of the proposed MYRP distribution program costs are associated with the company's grid improvement plan.
And then can you read the response?
Yes, the response is the grid improvement plan deferral ended 12/31/2022. Some of the proposed programs in the MYRP are a continuation of work in programs that were included in the grid improvement plan. These programs are listed below: SOG or self-optimizing grid, full and partial, distribution automation, voltage regulation and management, previously power electronics in the GIP, ADMS/DER phase 2, infrastructure integrity, and then parenthetically, some of this work was included under cybersecurity in the GIP.
Okay. Subject to check, would you agree then that there's some overlap, at least in the sort of project categorization naming of the spending in Power Forward and the grid improvement plan in the sub 1219 docket?
By naming, I agree for Power Forward. I don't know the details there, but absolutely there is similarities and continuations of GIP work. That's because we're addressing the mega trends. That is by design. And if the problem is that we continue to do the same thing, that's called consistency in distribution planning and addressing the needs we do. So yes, I do.
And would you agree that there's also some overlap, again, just in the naming categorization of project spending for the grid improvement plan and the proposed MYRP distribution projects at issue in this case?
Absolutely. The mega trends continue, and that's what we intend to do with the multi-year rate plan. We continue to address the mega trends.
All right, thank you. All right, let's talk a little bit about the proposed MYRP distribution projects at issue in this proceeding. In identifying and proposing the MYRP distribution projects for inclusion in DEP's application, DEP conducted cost-benefit analyses.
That is correct.
Yeah. And obviously, you know, these are relatively sort of nuanced, granular sort of analyses, but among other things, these analyses sort of compare the net present value of benefits over a period of time with the net present value of costs, broadly speaking.
Broadly speaking.
Okay. And I'm actually citing, I think, or at least pulling from your direct testimony here, the primary benefits that are incorporated in DEP's cost benefit analysis are operational savings from cost avoidance and savings from reliability improvements.
Say that one more time.
So the primary benefits incorporated in DEP's cost benefit analysis are operational savings from cost avoidance and savings from reliability improvements.
Just to clarify, there are some operational savings, but the vast majority of the savings are for customer benefits of avoiding an outage using the DOE's ICE calculator.
Yeah, right. So for purposes of DEP's cost benefit analysis, it was used to determine whether to include projects in the MYRP. Customer savings, and this is just sort of an illustrative example, customer savings that might sort of accrue from using customer-sited solar wouldn't be reflected on the benefit side of the ledger if those savings weren't tied to one of those primary benefits that we sort of discussed previously.
Can you repeat that?
Sure. And I can kind of rephrase it a little bit just in case it was not entirely clear the first time. So again, this is an illustrative or hypothetical example. Customer savings from using customer-sided solar wouldn't be reflected as, at least on the benefit side of the ledger, unless those savings could be tied to sort of that primary sort of benefit that you referenced earlier, which is, I guess, avoided outage benefits. I know we talked about, at least I talked about savings from liability improvements, but sort of how you captained it was avoided outage benefits.
Yeah, I'm not sure of a way you could actually estimate that. The reason we can estimate customer benefit for avoided outages is by leveraging the DOE's tool to do that and do that consistently. I'm not aware of a tool or method to be able to do that, so that was not done.
Yeah. I guess you would agree, though, that there could be savings, just that they might not or would not be reflected in that illustrative example.
I'm not sure who would save. I'm not, how that would be a savings.
For example, if somebody is using sort of customer-sided solar instead of some other more traditional sort of investment, they might have savings with respect to like their bill, but it might not be sort of a primary benefit that you referenced earlier, which is, you know, avoided outage benefits.
Yeah, that, I don't see that as an infrastructure benefit that would be part of that analysis.
Okay.
Or linked to our infrastructure investments we made on behalf of customers.
Right. And to go back again to avoided outage benefits, sort of when DEP is sort of doing its analysis for purposes of cost benefit analysis, those avoided outage benefits are considered in isolation for each sort of MYRP project.
That's correct, because the programs themselves are isolated to different parts of the circuit. For instance, self-optimizing grid is focused only on the main backbone of the circuit, the large three-phase sections, whereas something like hardening and resiliency laterals, equipment retrofit, those are focused on specific pieces of equipment in reference to equipment retrofit, and the H&R laterals is on laterals or tap lines, which are not part of the backbone of the circuit.
Okay. Moving on, so DEP gets at least some of its benefits information, I should say, for its cost benefit analysis from estimates from the interruption cost estimate calculator.
Yes, we do.
And so that model, just big picture, uses customer surveys and is updated, I believe, by Lawrence Berkeley National Lab. Is that right?
That's correct. And I believe they're working on an update now.
Gotcha. So I took a look at, and just for your context, this is Exhibit 8. Obviously, it's a compilation of sort of all the cost benefit analyses that were done with respect to the MYRP distribution projects.
This is in your notebook?
I'm talking about your Exhibit 8 of your direct testimony.
I'm there.
Okay. So would you agree that generally speaking, just based off of, the avoided sort of outage benefits that are listed for each of these individual categories of spending, would you agree that generally speaking, the residential class, at least compared to the other classes, seems to be getting less outage benefits from these distribution MYRP projects? And again, relative to the other classes.
In a monetized form, yes, because what this tool does is looks at loss of revenue or other financial impacts. And so commercial industrial, certainly loss of commerce with an interruption compared to more of an inconvenience or a small home-based business losing power and having an outage. So yes, that's reflected in the DOE's numbers, and they recognize that difference. But it doesn't mean that we're not improving the actual reliability experience for these customers. The tool just doesn't value that as highly as a commercial interruption for a manufacturing plant.
Sure. And I guess you sort of limited it to monetizable benefits, but I mean, as part of a record, is there any sort of quantification otherwise of the benefits that accrue from these projects for the residential class?
The residential class is the largest customer class we have by volume. And we're doing work on hundreds of substations, hundreds of circuits. Most of the customers on those circuits are residential. So when we do self-optimizing grid, unless it's truly an industrial circuit or in a heavy commercial area, the residential customers are receiving almost all of that benefit. We can't monetize it based on that tool because it just doesn't recognize the same value for my house versus a manufacturing plant.
Understood, but I mean, just for purposes of the record, is there information that you can point to where you sort of show, or other witnesses for DEP show those other benefits in a way that sort of tethers them or anchors it to something?
Not by rate class, but I can give you an example of what I was talking about with self-optimizing grid. That, excuse me just a second. So for example, as I mentioned, most of our customers that receive benefit from SOG are retail or residential customer class. With the work we proposed just in the 3 years of the multi-year rate plan, once that work is implemented in an annual incremental benefit above what we achieve today with self-optimizing grid, our customers will save another DEP North Carolina, another almost 120,000 avoided outages and over 21 million minutes of interruption avoided. And most of that will go to residential customers. The financial impact may be more significant as the calculator shows for commercial industrial, but as a residential customer, I would appreciate that.
Okay. And that's just for SOG for context. Okay. Would you agree, just as a general matter, that sort of the split or allocation of avoided outage benefits, excuse me, yeah, sorry. Would you agree that this split or allocation of outage benefits is separate from sort of the cost allocation of these projects to the different customer classes?
Can you repeat that? I'm sorry.
Would you agree that this split or allocation of avoided outage benefits is separate from the cost allocation of these distribution projects to the different customer classes? I can give you an example to kind of clarify this question.
If you would.
Yeah.
Just be sure I'm answering your question.
Just to use a hypothetical, I'm not using, these are not real numbers, but if the residential class, for purposes of the Exhibit 8 documents that you provided, gets only maybe 1% of the total outage benefits relative to all the customer classes, it wouldn't mean that the residential class would only pay for 1% of those covered projects.
That's a rates question. I'm not a rates witness. I'm sorry, I can't answer that. I don't know what that allocation is in that space.
Right. I guess, would you submit that the two at least are separate considerations? And
yes. Yeah. Rate making is separate from our.
One would not inform the other. Would you agree?
I can speak to what we do to improve the grid. How that works into rate making, I do not know.
Right. And I guess just to put a fine point on it, what that ends up being is something that's separately sort of determined.
Yes.
Okay.
Yeah, by rate structure.
Right. All right, moving on. I'm going to talk about a little bit about non-wires alternatives. So as part of identifying and proposing distribution projects for inclusion in DEP's MYRP proposal, DEP considered non-traditional solutions or non-wires alternatives.
Yes.
Yeah. And for purposes of your testimony, non-wires alternatives or non-traditional solutions basically are any solution that would defer or potentially remove the need to construct or upgrade components of the distribution system. Is that right?
And really focused on storage.
Yeah. And then subject to check, DEP is only proposing 2 non-wires alternative projects, Astral Rock Hill and the Hot Springs Battery Project.
So those are not in the MYRP.
Right. But they are, at least as currently proposed, at least my understanding is that they are seeking to defer certain, or not defer, but like to address certain issues with the grid. My understanding is at least one of them is designed to sort of address capacity constraints, I believe, and another one is also doing sort of similar things.
Subject to check, that may be a better question for the storage panel, sorry.
Okay, that's fine. All right, moving on. So currently DEP has one non-wires demonstration project. Is that right?
If you can give me the name, I may recognize it.
Yeah, it's the one through the Department of Energy's Connected Communities.
That would be also a better question for the storage panel. I'm not familiar with, I'm aware of that, but not familiar with that.
Okay, that's fine. We're going to stay on sort of this general topic. Can you turn to page 56 of your rebuttal testimony, starting on, I think, line 14?
What was the page again, please?
Page 56, line 14 of your rebuttal testimony.
I'm there.
Okay. So you note the prioritization methodology of GIP investments focuses on addressing the mega trends that you reference in your direct testimony. That's right?
That is correct.
So here, you talk about the recloser program and the targeted undergrounding program. These programs, as you sort of reference them, these are just illustrative examples of sort of the types of programs and spending that are informed by that prioritization methodology.
Yes.
Okay. All right. Now the company, actually, you note at the top of page 57 of your rebuttal testimony that the company, I should say, works to minimize environmental impacts. Is that right?
That is correct.
And you also note that environmental justice screening tools are being investigated for future inclusion into GIP planning.
I'm aware there's some activity in that place, yes.
And I just want to sort of clarify, when you say GIP planning, are you just talking about just grid modernization planning broadly? That would include just sort of anything that sort of the company does in sort of the distribution grid planning space, or is that a specific sort of reference
I
there?
think the broader reference would be appropriate, but maybe not all inclusive.
Okay. So again, you mentioned that being investigated for future inclusion, meaning that they aren't currently incorporated in Duke's sort of grid improvement planning, grid modernization planning, whatever you want to sort of refer to it
That's
as.
correct. We're focused on solving engineering problems, and that's more of a policy discussion.
Okay. Can I have you, so I'm referring now to the NCJC exhibit notebook. Can I have you turn to tab 21?
I'm there.
Chair Mitchell, at this time, I ask that this exhibit be marked as NCJC et al. Cross-examination, Guyton Maley, direct rebuttal exhibit 4.
Okay, just making sure, same document. This is a response to a data request.
That's right.
Dated April. Okay. Document will be marked as NCJC et al. Cross examination, Guyton Maley, direct rebuttal, exhibit number 4.
Okay. Mr. Guyton, can you read the request that's listed on this document in full?
Let's see, the request says 19.9, refer to page 57, lines 9 through 11. Please explain in detail the progress of the company's investigation into including environmental justice screening tools and metrics in future GIP planning, including when the company anticipates these tools and metrics will be incorporated, any challenges or obstacles that would impede or delay their projected incorporation, and how the company envisions these tools and metrics would be incorporated.
Can you take some time to review the response that's listed there?
You want me to read the response?
That's fine. I can do that.
I'll review it.
Just let me know when you're done.
I'm done.
Would you agree, based off of that response, the company at this time does not have a definite timeline to incorporate these screening tools into its GIP planning or grid modernization planning?
I'm not aware of one, but that may be more of a policy question for those that are heavily involved in their roadmap for that.
Okay, that's fine. Let's turn finally to distribution metrics. Mr. Guyton, can I have you turn to page 16 of your direct testimony, starting around line 14, and just let me know when you get there.
Page 14 or 16?
So it's page 16, starting on line 14.
I'm there.
Right. So as a measure of DEP's distribution system effectiveness, DEP relies on SAFE and SAIDI scores.
That is correct.
And just to kind of paraphrase, SAIDI measures sort of at the DEP system level how long any interruption, I believe over 5 minutes, lasts for the average customer during some set period. It could be a calendar year, month, whatever.
That's correct. It's a duration metric.
Okay. So safety measures, I guess in contrast, again at the DEP system level, how often the average customer experiences an interruption over 5 minutes, again during a set time frame. Could be a calendar year, could be a month, could be whatever.
Yes, that's a frequency metric.
And not to put too fine a point on this, these are system-wide metrics, right?
That is correct.
So meaning currently DEP doesn't report to the commission SAIDI or safety scores at a level more local than sort of the system level.
Not that I'm aware of.
I know, obviously, I'm not asking you to sort of opine upon this. I'm just saying, just for context, I know that there is a settlement that sort of touches on some of these issues. But setting that aside, again, not to bear too much of a point on this, but DEP doesn't report service reliability issues generally at a level more local than the system level.
We don't report that, but our data that informed our multi-year rate plan projects is down to the protective device for every circuit in the Carolinas, every substation. We look at every protective device. All that went into our MRP projects.
But
Down to the protected device, but we do not report to that level.
Yeah.
Correct. We look at outage history at that level.
definitely understand that, informs sort of DEP's decision-making, but just as a general matter, we don't sort of see the data behind that that's informing sort of those decisions with respect to sort of the protected devices and these other improvements that DEP is making.
Not in our reporting to the commission, though.
So I guess as a result of all of that, would you agree that the company, commission, and stakeholders, or at least the commission and stakeholders, don't currently have a way of evaluating whether certain communities might experience more frequent or longer outages than others?
Not from our reporting.
Okay. No further questions.
Right, Sierra Club. Thank you. Good afternoon, everyone. My name is Andrea Bonvecchio. I'm here on behalf of the Sierra Club. Mr. Malley, back to you. I just have a couple of questions for you. May I approach the witness with their binder?
Sure. Thanks.
All right. So if you'll please turn to page 5 of your direct testimony.
I'm sorry, was this his direct testimony?
Yes, sir.
Okay, I'm there.
Great. And on lines 9 and 10, while you provide an overview of your testimony, you state that the company understands that, quote, more must be done to improve the state's energy infrastructure to meet the challenges and opportunities that lie ahead, correct?
That's correct.
Would you agree that a challenge that lies ahead is the capacity of the company's transmission system to interconnect more solar and other distributed energy resources?
Yes, certainly, and specifically related to the carbon plan in our case.
Okay. Would you agree that there are also opportunities that lie ahead for supporting a conversion to new sources of energy?
Yes.
And so on that same page on line 11, you state that DEP's MYRP is designed to address those challenges and opportunities that you state lie ahead. Is that correct?
Yes, that is correct.
Okay. And so if you'll now flip to page 30 and 31 of your direct testimony.
I'm there.
Okay. So specifically on page 31, lines 8 through 10, you state that, quote, for the transmission expansion plan projects, past and continuing studies of proposed generator interconnections inform the need for capacity uprates to allow for future generation additions. Is that correct?
Correct.
Okay. So if you could please turn to tab 32 of the binder I just handed you, which was previously pre-marked as Sierra Club Potential Cross Exhibit 32.
Okay, tab 32, you said.
Yes, sir. And it should,
There.
okay. It should be DEP response to Sierra Club data request 211.
Correct.
All right. Chair Mitchell, at this time, we'll request that this exhibit be marked for identification as Sierra Club cross-examination, Malley and Guyton direct rebuttal exhibit 1.
All right, the document will be so marked.
Thank you. Mr. Malley, could you look through this and let me know if you're familiar with this data request and the response that was provided?
Yes, I will. Yes, I'm familiar with this.
Okay. And so according to the document's first page, you did not provide this response to the Sierra Club, correct?
I did review this response.
Okay. The response was provided by Elisa Ewald.
That's correct. We have numerous subject matter experts that support responses to data requests. So we get the right subject matter experts involved.
Okay, great. And did she consult with you during the preparation of this response?
Yes, as I mentioned, I approved of this response.
Okay. And if you'll flip to the second page, this data request refers to the portion of your direct testimony that we just went over on page 31, lines 8 through 10, correct?
Yes.
And the request asks for a description of how generator interconnection studies are accounted for in determining the need for capacity upgrades in the transmission expansion plan, correct?
That's correct.
And so looking at the response, starting towards the middle of the paragraph, the fourth sentence that reads, quote, moving forward, methods for identifying capacity upgrades are DICES studies and public policy request studies. Those studies identify necessary transmission upgrades to accommodate generation additions. Do you see that?
I do see that.
And so do those processes or studies identified in that response, do they currently integrate a proactive multi-value transmission planning approach, or are they only reviewing the transmission upgrades needed for a specific proposed generating unit?
Right. So specifically for the public policy request studies, that's something that's handled under the local transmission planning process, in our case, the NCTPC. I will say that the NCTPC is considering the multi-value transmission planning approach. That is a new approach. I'm not an expert in that area, but again, the local transmission planning process is evaluating the what it would take and the warrant, the benefits essentially of adopting that multi-value approach.
Okay, and that kind of segues into this next question. The next sentence after that, starting with future transmission expansion plans for accommodating generator additions will be determined through, and then it lists out a couple of processes. Do you see that?
I do.
And so do the processes listed in that sentence, the FERC-approved OATT process, the large generator interconnection, attachment J, or the NCTPC local transmission planning process, do any of those processes currently integrate a proactive multi-value transmission planning approach?
The third one, the NCTPC, as I mentioned, that is the process that is evaluating the multi-value transmission planning process. I'm not familiar in specific detail with those other processes.
Okay, so those are all the questions I have for you on your direct testimony. Thank you. And so now we'll move to your rebuttal testimony, please. Okay, and if you'll please turn to page 44.
I'm there.
Faster than me. Okay. All right. And on lines 12 through 16, when addressing Sierra Club witness Michael Goggins' testimony, you state that his recommendations are more appropriately addressed through the carbon plan, IRP, or NCTPC processes, correct?
Yes, that's correct.
And the recommendation you're referring to is Mr. Goggins' recommendation that the commission direct Duke to adopt or use a proactive and multi-value approach to transmission planning and to file a proactive transmission plan, correct?
Yeah, that's correct. I mean, and to elaborate, the carbon plan, again, had some specific discussion related to proactive transmission planning. In fact, a group of projects called the Red Zone projects came out of that proactive planning. And that's a key first step of our carbon plan. And we have incorporated those projects into the multi-year rate plan since they are within the planning horizon, the 3-year planning horizon looking forward. So we have included proactive transmission planning within our multi-year rate plan.
And so you mentioned the RZEP projects. Are the RZEP are they at scale to be proactive and long-term, or is it just incremental?
So again, the multi-year rate plan is a limited planning horizon. It's a 3-year window ending in 2026. So we have included an aggressive schedule of pursuing red zone expansion plan projects within that window.
Okay.
We do have additional projects beyond that window.
So the company would be confident that in future MYRPs, they will not be seeking additional recovery of costs to upgrade the currently proposed RZEP projects.
I'm not a cost recovery witness, but from an operational perspective, I'll just restate the projects included in the multi-year rate plan we are seeking cost treatment under the rules of the multi-year rate plan.
Okay. And if you'll turn to page 46 of your rebuttal testimony, please.
Okay.
On lines 4 through 10, you also state that Mr. Goggins' recommendations are unnecessary because Duke Energy shared in its March 15th, 2023 NCTPC Transmission Advisory Group presentation that it is, quote, pursuing the integration of a multi-value strategic transmission planning study into the local transmission planning process, correct?
Yes, that's correct. And the impetus behind that is that a policy change to adopt some rule around how we perform transmission planning would appropriately fit under that local transmission planning process, which is a FERC process. And again, the multi-year rate plan is a short-term planning mechanism, or a 3-year horizon mechanism to pursue special cost treatment of our near-term investments.
Okay. If you could please turn to tab 35 of our binder, and the document should be pre-marked as Sierra Club Potential Cross Exhibit 35.
Yes, I'm there.
All right. Chair Mitchell, at this time, we'll request that this exhibit be marked for identification as Sierra Club Cross-Examination, Malley and Guyton Direct Rebuttal Exhibit 2.
Well, let's make sure we're looking at the same document. This is the tag meeting, March 15th, 2023.
Yes, Chair
Okay.
Mitchell.
All right. Document will be so marked.
Thank you. Mr. Malley, this is the presentation from the NCTPC Transmission Advisory Group's March 15th, 2023 meeting that you reference on page 46 of your rebuttal testimony.
Yes, that is correct.
So if you'll please turn to page 20 of that document of the presentation.
I'm there.
Thank you. Where it says below that blue heading, quote, NCTPC transmission planning process changes to consider. Do you see that?
I do.
And you sort of covered this a little earlier, but does that mean that as of March 15th, 2023, there is no commitment in the NCTPC to implement a multi-value strategic approach?
That is my understanding, that it is being evaluated.
Okay. And then just one more document to look at. If you could please turn to tab 47 of that binder, which was pre-marked as Sierra Club Potential Cross Exhibit 47. And it should be the NCTPC report on the NCTPC 2022 to 2032 Collaborative Transmission Plan final report.
I'm there.
Chair Mitchell, at this time, we'll request that this exhibit be marked for identification as Sierra Club Cross-Examination, Malley and Guyton Direct Rebuttal Exhibit 3.
All right, please remind me of the proposed exhibit number.
3.
Okay.
Oh, I'm sorry, from our binder, it was tab 47, potential exhibit 47.
All right. Document will be so marked.
Thank you. Mr. Malley, this is as we just went over, this is a copy of the final report that was dated February 21st, 2023. Are you familiar with this report?
I'm not familiar with it.
Okay, if you'll flip to the second page to the table of contents, you'll see that after section 1, the executive summary, section 2 goes over the NCTPC process and provides an overview of the process. Do you see that?
I do.
Are you familiar with the NCTPC process?
Only at a high level.
Could you please turn to page 33 of this report?
Yes.
Which should illustrate a flow chart, and it's labeled as 2022 NCTPC process flow chart.
Yes.
Do you know whether this is an accurate depiction of the current NCTPC process?
I do not. I do not know that level of detail.
Okay. Would you agree, based on this chart, and I can give you a minute to look over it, that to evaluate multiple benefits, the NCTPC uses 4 separate processes?
I do see the 4 processes laid out in the left-hand column.
That's right. And is the only process that is required the reliability planning process?
I don't know the answer to that.
Okay. Are the processes listed under the reliability planning process, the resource supply options process, the local public policy process, and the local economic study process? Does this chart represent that those are optional?
It does. I agree with that.
Okay. So would you agree that as currently organized, there is no guarantee in the NCTPC that any transmission plan will be proactive and assess multiple benefits?
I would agree that, yes, based on this, there does not appear to be policy that requires the implementation of those aforementioned items.
If the commission were to order the company to do a proactive multi-value transmission analysis outside of the NCTPC, would the company oblige?
So fundamentally, we're not opposed to evaluating proactive or multi-value transmission planning. Our position is that this docket, the multi-rate plan, is not an appropriate forum for those discussions, since that is really a change in policy, and specifically the local transmission planning policy is a FERC implemented policy.
Okay. And I understand that to be your position. Could the company use that plan in that hypothetical to inform future MYRPs?
It's possible. I mean, certainly we look at various different drivers and reasons, anytime we evaluate a potential investment. So I would say that's possible.
Okay. I think I just have a couple more questions. Since you cited in your testimony, I can assume that you're familiar with Mr. Goggins' testimony on behalf of the Sierra Club, correct?
I have read it.
All right. And we already established earlier that he advocates for a proactive multi-value transmission planning approach, correct?
Correct.
Would you agree that for the long-term or proactive aspect of Mr. Goggins' recommendations, your testimony states that that would, quote, fit better in the carbon plan and IRP process?
Yes, my rebuttal testimony does state that.
Okay. Would the company be in a better position to optimally and cost effectively upgrade its transmission system if it were to rely on one holistic review that captures multiple benefits instead of various reviews in the multiple forums that you've identified?
That may be the case, but again, the appropriate policy or requirement there would best fit under the carbon plan IRP process.
Okay. And just one more, if the commission were to order the company, again, to do a proactive multi-value transmission analysis outside of the carbon plan and IRP process, would the company oblige and use that plan to inform future carbon plan and IRPs?
Well, certainly if the commission makes an order obliging us to do something, we will follow that order.
That's fair. All right, those are all the questions I have for you. Thank you for your time.
Thank you.
Right, redirect.
Thank you, Chair Mitchell. Just a couple of questions. Mr. Guyton, I think you're first. And these questions, I've got two areas I want to explore with you real quickly.
Sure.
And they both relate to your conversations with the NCJC attorney. The first, do you recall a discussion a few minutes ago regarding the stakeholder feedback process that the company has utilized with distribution stakeholders?
I do.
All right. So would you agree with me that Duke Energy Progress has the primary responsibility to provide safe and reliable electric service to its customers?
Absolutely.
And do stakeholders have any responsibility in that regard?
None whatsoever.
And who is Duke Energy Progress accountable to with regard to that safe and reliable service?
This commission.
All right. But it's nonetheless, it's DEP's position that they're willing to listen to and participate in stakeholder proceedings with interested parties?
Yes, we are.
Okay, thank you. You also had some conversations, again, with the NCJC Council regarding, I guess, prior dockets in which the company has pursued either identical or similar projects to what's now being included in the MYRP docket. Do you recall that?
Yes, I do.
All right. So, and I think we started with some orders, some commission orders that may have come out of Power Forward that were dated 2018, if my notes are accurate. So, would you agree with me that that DEP has been working on the grid improvements necessary to address the mega trends since at least 2018?
Yes, I would.
Are you done with those projects?
No, we're not. The mega trends continue.
All right. And is that why they're included in the MYRP?
Absolutely.
All right. Thanks. And I have one question for Mr. Malley, if I can find it. Mr. Malley, you just had a conversation with Sierra Club Council, and the last subject that you covered was this idea of, would it be better to have one transmission review versus ongoing review and IRP and carbon plan dockets with regard to transmission planning? I wanted to ask you a question. Is transmission planning static?
No, it is not. It changes quite regularly based on load forecasts, various other inputs to the planning process.
So would you anticipate that in the normal course of engaging in transmission planning for the company that that plans that maybe were initially developed might change as you move forward in time?
Absolutely. We do see plans change over time, and it's our obligation to reevaluate those plans under the most recent projections.
Thank you. That's all the questions I have, Chair Mitchell.
All right, I'll take questions from commissioners. Any questions down here? Okay. Okay, go ahead, Commissioner Clodfelter.
Mr. Guyton, good afternoon.
Afternoon.
I've got one fairly simple question for you, and it derives from my lack of imagination. So the hazard tree program. So I read the program description. Duke employees go out and they identify what you define as a hazard tree. And you find a hazard tree, and then you go to a supplier or third-party contractor, and they work with the property owner and get the tree taken down or pruned, or
it would be taken down if it's a hazard tree.
If it's a hazard tree, taken down. So I understand. And then, but what I don't understand, a lack of imagination for, is why are you spending $48 million worth of capital expense on that program? What's the capital expenditure for in that program?
So I'm not an accountant from that perspective, but my understanding, that may be a better question for an accounting witness. One, it follows the capitalization policy that we can do, but I believe the reason for that is the hazard trees are actually outside of our maintained right of way. So any maintenance trimming we're doing is O&M, but this is essentially analogous to expanding the right of way, which be a capital project by removing those trees outside the right of way.
It's treated as capital because the tree is not in your right of way.
Yes, if it was in the right of way, that would be maintenance trimming O&M from that perspective.
But the work that's done is work by a third-party contractor to take it down, and then Duke writes a check to the contractor to pay for the contractor taking it down.
It's one of our normal, we use our normal vegetation management contractors to remove those trees, but yes,
Don't involve any Duke equipment.
no. In fact, the actual assessment is done by contract employees as well, part of our vegetation management groups that do the assessment.
You've taken me as far as I think you can take me. I will ask one of the accounting witnesses. Thank you, sir.
You're welcome.
That's all. As I said, it was pretty simple.
All right, Mr. Guyton, you're off the hook. Mr. Maley, we have a couple of questions for you.
Sure.
All right, your testimony discusses outages per 100 miles per year sustained automatic metric. Okay, I'm glad to see you
Yes.
shaking your head. All right, nodding your head. You note that relay and control system events, along with vegetation management issues, are the drivers for the increase in this metric. Like, help us understand what relay and control system events are.
Sure. So a protective relay is a device that senses a fault on the transmission grid. One of the reasons why we're seeing these events be a driver is and this really ties closely to our system intelligence investments. So we are going through and we are modernizing our protective relays. So those sensing devices, we're removing the old, aged, end-of-life assets that are approaching or are failing. We're replacing those with upgraded digital protective relays. But when a relay fails, what it does is it sends a signal to interrupt the transmission grid. So it may not actually, there may not actually be a fault present on the transmission grid, or the relay is slow. The relay is slow to respond, in which case a backup protective relay will also respond. It will sense the fault, which means what we're doing is we're expanding the area that the transmission grid is actually isolating. So those relays are sending signals to circuit breakers, they're opening up and isolating sections of the grid. So when we have a situation at a substation that may connect 3, 4, 5 different transmission lines, and there's a relay that may be slow to operate or fails to operate, you can actually impact multiple transmission lines from one protective relay failure. So that is generally sort of a description of the cause and effect. And again, the reason we're seeing an increase in failures is we are approaching end of life for a number of our largely electromechanical type relays. We're replacing those with digital relays.
Okay. And just for my own edification, replacement happens after failure.
Right. So our intention is certainly to identify and replace prior to failure. So we have a rigorous testing program in place for our transmission class relays. We test those. We determine if they're approaching failure. Obviously, if we need to make immediate fixes, we do that. When a relay fails, we then have to go replace it after the fact, but it is our intention to replace the relays prior to failure, prior to the customer seeing an impact.
Okay. All right. In your direct testimony, you indicate that the grid improvement plan work from the previous rate case was on track to be completed by December 2022. Can you confirm that that work has in fact been completed?
Yes, the
Okay.
grid improvement plan is complete as of December 2022.
Okay. All right. In your rebuttal testimony, you discuss the potential interdependencies of multi-year rate plan projects. This is around page 35. And how these projects are planned by the transmission outage coordination team to ensure continuity of service, et cetera.
Yes.
Does this process result in changing the timing of the projects?
It can certainly. So we need to work within the available outage windows, which can be seasonal. Of course, certain transmission lines, we can only take out of service certain times of year. So there are times when we have a constraint and we cannot do perhaps have multiple outages at the same time. We may need to adjust and move outages back. So we spend a lot of time in our project planning and development phase to look ahead and look at what outage season are we targeting this work in? What are the other projects that associated or I'll say adjacent substations and transmission lines that may interfere with this? And we sequence those as early as possible to minimize the number of changes as we get closer to the construction period for the project.
Okay. For the specific projects that you all have proposed in the context of this multi-year rate plan application, did this drive for efficiencies result in more projects coming into the plan or projects being removed from the plan?
I really keep efficiencies and interdependencies as kind of separate issues. They're not highly related to each other. As far as changes in the plan, as the commission has seen in our supplemental, we did have we have experienced some changes in our plan, in our in-service dates and our scope of some of our projects. But overall, that's been a small percentage. I'd say we've stayed relatively consistent from overall multi-year rate plan portfolio. So I'm not sure I answered your question, so I'm going to give you another opportunity maybe.
You came close enough.
Okay, thank you.
Close enough. All right. Now you've testified on page 42 of your rebuttal that rate year one represents a period of 18 months. Do you remember this testimony from April 23 through the end of September 24?
Correct.
Rate years 2 and 3 represent budgets over 12-month periods. So 2 and 3 would be 12-month periods. 1 is a 18-month period. Can you confirm for us that the multi-year rate plan projects with an in-service date that falls between April 1, 23 and the end of September 23 are included in rate year 1 for cost recovery purposes? And if I need to ask this question of someone else, let me know.
Yes, I would defer that to a rates witness would be more appropriate for that rate year 1 question.
Okay. All right. Well, I will save that one for Ms. Bateman. All right. Anyone have questions before I turn it back over to the parties? All right. Questions on commissioners' questions? Mr. Josie, anything? Okay.
No questions, Chair Mitchell.
All right. Well, then with that, gentlemen, you may step down and be excused. Thank you very much for your testimony this afternoon.
Thank you.
All right. Well,
Chair Mitchell, would it be appropriate to move exhibits into evidence at this time?
you anticipated my next.
And Duke Energy Progress would move into evidence the pre-filed direct, supplemental, and rebuttal exhibits of witnesses Malley and Guyton as previously marked.
All right. That motion is allowed.
Chair Mitchell, the AGO would move AGO cross-examination, Guyton, Malley, direct, and rebuttal exhibit 1 into
Motion is allowed.
Chair Mitchell, at this time, NCJC et al. Would move to enter into the record NCJC et al. Cross-examination, Guyton rebuttal, direct exhibits 1 through 4 into the record.
All right. That motion is allowed.
Chair Mitchell, at this time, Sierra Club would move that Sierra Club cross-examination, Malley and Guyton, direct rebuttal exhibit 1, 2, and 3 be entered into the record.
Your motion's allowed. All right. With that, we will take our afternoon break. Let's take 20 minutes. We'll be back on the record at 3:15. Let's go off the record, please. Record, please. All right, Duke, you may call your witness, please.
Thank you, Chair Mitchell. Brandon Marzo on behalf of Duke Energy Progress. Good to see the commission again. It's been, I think, since 21. My next witness is Mr. Spanos, John Spanos. Ask that he be sworn in.
All right, good afternoon, Mr. Spanos. Raise your right hand, please, sir. Left hand on the Bible. Swear testimony you're about to give shall be the truth, the whole truth, and nothing but the truth, so help you God.
I do.
All right, Mr. Marzo.
Thank you, Chair Mitchell. Mr. Spanos, would you please state your full name and business address for the record?
John J. Spanos, 207 Senate Avenue, Camp Hill, Pennsylvania, 17011.
And by whom are you employed and in what capacity?
I'm employed by Gannon Funding Valuation and Rate Consultants LLC, and I'm the president.
Mr. Spanos, on October 6th of 2022, did you pre-file or cause to be pre-filed 20 pages of direct testimony in question and answer format?
Yes, I did.
Are there any corrections you need to make to your pre-filed direct testimony?
No, there's not.
If I were to ask you the same questions today under oath, would your answer be the same as set forth in your pre-filed direct testimony?
Yes, they would.
Mr. Spanos, as part of your pre-filed direct testimony in this docket, did you also pre-file Spanos Direct Exhibits 1 and 2 and Spanos Appendix, A?
Yes, I did.
Were the exhibits and appendix prepared on your supervision and direction?
Yes, they were.
Do you have any changes or corrections you need to make to your direct exhibits or appendix?
No, I do not.
Mr. Spanos, on April 14th of 2023, did you also pre-file or cause to be pre-filed 32 pages of rebuttal testimony in question and answer format?
Yes, I did.
Are there any corrections you need to make to your pre-filed rebuttal testimony?
No, there is not.
If I were to ask you the same questions today under oath, would your answers be the same as set forth in your pre-filed rebuttal testimony?
Yes, they would.
Chair Mitchell, at this time, I'd ask that Mr. Spanos' pre-filed direct and rebuttal testimony be copied into record if given orally here today.
All right, direct testimony of witness Spanos filed on October 6th, 2022, consisting of 20 pages plus one appendix, will be copied in the record as if given orally from the stand. The two exhibits to that testimony will be marked for identification as they were when pre-filed. Rebuttal testimony of the witness filed on April 16th, 2023, consisting of 32 pages, will be copied into the record as if given orally from the stand.
Thank you, Chair Mitchell. Mr. Spanos, did you also have a summary of your direct and rebuttal testimonies that you prepared or caused to be pre-filed in this docket on May 3rd, 2023?
Yes, I did.
Chair Mitchell, I'd ask that Mr. Spanos' testimony summary be read into be copied in the records if it was read orally from the stand.
All right, testimony summaries for the witness will be copied into the record as if delivered orally from the stand.
Chair Mitchell, the witness is available for cross-examination and questions from commissioners.
All right, my notes indicate that Fayetteville Public Works Commission is the only party with cross. You may proceed, Mr. West.
James West of the Fayetteville Public Works Commission. Good afternoon, Mr. Spanos.
Good afternoon.
I wanted to start by talking to you about the process that you use to determine the retirement date for various steam production units and other generating units. And one of the things that stood out when I looked at your testimony and your exhibit was that you had numerous conversations with management. Is my understanding generally correct?
I have, and as customary for all my studies, I have discussions with management. That would include past studies for, in this case, Duke Energy Progress.
So when you say you've had conversations with Duke management, can you be a little more specific? Are you having conversations with operational people or other groups?
It would include operational people and financial people. During the course of my study, when I do my site visits, I'll go and talk to the operational people at each particular site. In this case, Mayo and Roxborough, as well as some of the CTs.
And what sorts of things are you asking them about?
Some of the things that are important for me in determining life characteristics would be plans for retirement of specific assets, not the entire site itself, but specific assets, new projects that would be happening and going forward for the facility, looking at condition of the facility and asking questions as we're doing our tour to understand the expectations of the assets and how things may change functionally for various reasons.
Do you also look at the availability of replacement assets in the event that you determine that an asset is getting close to retirement age?
Well, one of the questions that I'll ask is if you're going to replace, let's say a boiler feed pump, within your plans, are you able to get a boiler feed pump in time to be able to replace it when it's needed? Is that fitting your schedule? So those types of assets, I would ask about. They may say, well, we know that we're going to have to go to a different style of boiler feed pump going forward. So that's, again, information that you obtain while doing your site visit.
What about situations in which the entire plant or entire site is going to be retired? Do you look at the availability of replacement assets in those circumstances?
Can you give me a little better understanding what you mean by replacement assets if an entire facility is being replaced?
Let's try this. Let's look at your Spanos Exhibit 1, pages 39 and 40 of 688. And specifically, I'd like to direct your attention to the top of page 40 of 688, which is also marked Roman numeral 3-7. And the first two sentences talk about a lifespan estimate for combustion turbines, which you've identified as 40 years as a result of a range of 40 to 53 years being estimated. But then you said, however, a couple of facilities were extended to meet possible load changes. Can you explain what you mean by that?
Sure. For example, the Blewett, if you look at the bottom in the table here, the Blewett facility was extended to 2030 so that it has longer than the 40-year lifespan. And that was because there was expectations that they were able to continue to operate that facility under its current plan a little bit longer than they did at that time. So, CTs aren't used that much. They're peakers. So they are really under high load moments. So it could be a 3-hour window in a day. It could be a high time period during a week in the year. So those are units that aren't used on a regular, they're not a base load unit. So they have, can they continue to operate with minimal amount of starts during the course of a year? And the Blewett one, for example, was one that was what I was describing there.
So the Blewett unit is a combustion turbine, correct?
It's what I call simple cycle combustion turbine, yes.
Right. And then on the next page, page 41 of 688, there's a Weatherspoon unit that also has a depreciable lifespan of 60 years and runs through 2030. What is Weatherspoon?
Similar, these, the majority, if they don't say CC in the name, then they are, or solar, then they are a combustion turbine. So that was another unit that, based on where it's configured in the system, they were able to extend the expectation for those units.
And when you talk about, I assume that those are the two facilities that were extended to meet possible load changes. Is my assumption correct?
That was the intent of the question. It's not going to cover all load changes, but it is going to, that was part of the reason why we were able to extend those based on the company plans.
Okay, so would you please explain what you mean by possible load changes?
So in many cases, you'll have a different, again, load during the course of a day. So if it's only going to be a short period of time during the course of a day, and you can get it accomplished by a peaker instead of having a base load unit in operation, that's a scenario where if we can meet demand on a regular basis with less base load units and take those high levels during the course of a day, or a week in the summer, something along those lines. That's what I was talking about in that particular sense.
Okay, but combustion turbines and other peaking facilities are used on essentially a daily basis to meet the peaks that occur during the day, correct?
Not all of them are used to that degree. I mean, it's possible that the Weatherspoon, and I don't have the specific numbers in front of me, but it's possible Weatherspoon might only be started 40 times during the course of a year or 20 times during the course of the year. Many of these, they're either emergency backup units or peaking units during a small portion of the time, but they still allow you to meet the demand that you have at that point in time instead of having to build a bigger type of steam baseload unit.
Sure, but if you're using a combustion turbine for peaking needs, right? Would you not replace, if you were going to retire it, would you not replace it with additional peaking capacity typically?
Not, I wouldn't say that there's a standard answer to that question. It all depends on what's going on with the system, where there's growth in the system, utilization of the system. It's possible that you could replace, a lot of your generation with wind or solar, and that will affect differently your combustion turbines than when you have a steam unit. So all of that mix of generation is affecting the utilization of the assets. So it's not a standard answer to your question.
So did you evaluate whether Duke was planning additional assets to replace Blewett and or Weatherspoon?
I didn't go through and analyze whether they were going to replace those. The company's plans were to extend those because they could handle what was necessary if we moved it out 5 extra years, which is what we did. They used to be 2025.
Okay, great. So now we're back to the management discussions, and management was telling you we can engage in the maintenance that we need to extend the life of the units to keep them running through 2030. Is that accurate?
That's a fair assessment, but these are two CTs, which are a small percentage of the generation.
Sure. And so you accepted their information and included that in your retirement plan dates for these particular assets, correct?
Well, that's a similar discussion I have with many other utilities across the country as to how they're rearranging their generation to meet demands. Many of them have renewables that are coming into play and how the renewables affect their existing assets. So in this particular case, Witherspoon and Blewett were the ones that they were able to extend. They explained to me that they were going to do that to meet some of the load changes. And I agreed with that because it's a common practice in the industry. There didn't seem to be anything that drove me to feel as though that wasn't an accurate process.
Is there a cost effectiveness analysis that either you or Duke undertakes for purposes of that discussion?
I don't know whether, Duke has their probability schedules that they put together, and then I review those. It's just similar to what everybody else does. I wouldn't say that there's, for me, that I focus on a cost benefit analysis of each of them. Obviously you have to be able to meet the demands. You have to make sure that you're able to do that with the existing assets you have or what you're going to replace it with. And in this particular case, for those two, extending them 5 years, we're going to be able to meet the expectations for what they were going to use those assets for 5 more years than what they currently had them listed as.
And when you say meet the demands, just to be clear, what we're talking about is the minute by minute load of retail and wholesale customers and other purchasers on the Duke system. Is that correct?
Yes, but again, Witherspoon and Blewett are a very small percentage of all of the demands of the system.
So do you also take into account or ask Duke about environmental constraints?
I have during the course of my work. I do work for many Duke entities, so I am familiar with what their plans are and expectations are. And so I have taken that into consideration. Obviously, on the steam side, that's much more of an issue.
So is the answer yes, you took into account environmental constraints for these particular units?
Are you asking Witherspoon and Blewett?
Sure, yes.
Those particular units don't have as many environmental issues as some of the steam units. So there, I didn't find any that were concerning to me for those particular units, but for the steam units, there are some.
What environmental units are you referring to? Or what environmental issues are you referring to?
Well, there's regulation, particularly for coal-fired facilities right now across the country that, and the fact of the, natural gas prices as to whether a lot of these factors are important to continue to operate steam facilities. So when you take that into consideration with some of the regulation that's out there to replace coal across the country, that is things that I took into consideration.
Oh, can you be a little more specific to North Carolina or to Duke? Are there environmental regulations that you looked at for Duke specifically to determine what the appropriate retirement dates were for Duke's units?
That's not necessarily the only driver for these particular units.
Is it a driver?
To me, it's a driver for coal to be considered as to understanding that, clean air and emissions are a factor, and you have to take that into consideration, and you can't wait too long to be able to react to that. So that is something that I consider when I look at all my generating facilities.
So what specifically did you look at for Duke when you evaluated its units?
Well, again, I take into consideration all of the Duke entities and what's going on with all of the Duke entities. So that is a lot of the types of information that I take into consideration as to what would drive replacement of those assets. And just like many others across the country, there is a lot of reasons to right size the recovery patterns and life characteristics of steam facilities. And so that is the type of thing that I take into consideration. And if you look at what's happening to not only the Duke facilities, but many others across the country over the last 8 years, many of them are being retired, sooner than they originally had planned or when they had prior to that time, because they're not as cost efficient and they create clean air issues that you have to continue to invest dollars in. That doesn't make sense.
Right, but you're making, in this case, retirement recommendations for Duke's fossil fuel fired units, correct?
I'm making recommendations for all of Duke Energy Progress's generating utility units, and that includes my understanding of what Duke is planning to do.
So what specific environmental constraints did you look at when you made the determinations about what the retirement dates should be for the various units that are depicted on Exhibit JJS1, page 40 of 688?
Madam Chair, I think this has been asked and answered.
He has yet to name a single environmental rule, statute, regulation that he looked at to make the determination as to when these units should be retired. And he said that that was a factor he took into consideration when making recommendations. So I'm simply asking him to tell us which ones he looked at.
All right, Mr. Spanos, answer the question and then let's move on.
For these particular units, I did not look at any specific environmental regulations that would have driven the life characteristics, because that was part of the work that Duke had already done.
Meaning, just to clarify, Duke told you what their constraints are?
They told me what considerations that they have for probable retirement dates of these units. And that's what drove me to support the estimates that they had utilized for, in this case, Mayo and Roxborough.
Okay, so since you brought up Mayo and Roxborough, are the dates that are listed on this page 2028 for Mayo 1, 2028 for Roxborough 1 and 2, and 2027 for Roxborough 3 and 4? Were they given to you by Duke based on its own system constraints, or did you give Duke those dates?
The initial, Duke supplied me with their schedules as to what their plans are for each of the units. And then I reviewed those and confirmed whether they were reasonable expectations based on the overall lifespans. These are probable retirement dates, and currently, units that are being retired have a lifespan of 45 to 50 years. All of the Mayo and Roxborough either meet that or are longer than that with their current dates. So that was how I supported the fact that the dates that they had come up with are consistent with what's going on in the industry.
So when you identify in this page 40 of 688 that the depreciable life date or the planned retirement date for Roxborough units 3 and 4 is 2027, did that date come from Duke?
Duke made the initial recommendation, and then I evaluated that recommendation and agreed with that recommendation.
Okay, so you accepted Duke's recommendation to retire Roxborough 3 and 4 in 2027.
In this particular case, they did the initial presentation to me, and then I reviewed that and agreed, but after asking questions and going through that process, agreed with those dates. It's consistent with what I see in the industry happening for coal-fired plants. So all the information I had supported a reasonable life expectation that is 2028, 2027 for the respective units.
Okay, so I think you're maybe getting a little bit ahead of me, but for Roxborough units 1 and 2, which have a retirement date of 2028, did that also come from Duke, and then you evaluated it for reasonableness and accepted it?
All of those particular units, and some of that relates to dollars that had been capital work that had been done as to whether that's a reasonable expectation with the work that they have done. So yes, that they came and presented the initial information based on my questions. I said, what's your expectations and plans for each of your generating units?
Right, and then the Mayo unit 1 retirement date of 2028, that also came from Duke, and then you were able to verify it through your evaluation process. Is that correct?
That's correct.
And from whom at Duke do those dates come? Is there a particular group or person?
Well, the people that I deal with are the generation folks. I don't know who supplied me who the initial document came from, but I requested property accounting supplies it to me because that's the main communication that I have. So the generational folks and planning folks are the ones that supply property accounting, who supplies it to me. And then I talk to the people at the sites.
So I'd like to get a sense of timeline, if you can help me with that. I noticed that your study stated as of December 31, 2021, but it was sent to Duke in July 2022 with a cover letter that essentially said, here's the final report. Do I have the time basically correct?
The test year date, which is what I have the accounting records for, were through December 31, 2021, which is what you stated. And the letter that I ended up sending with the final report was July 20th, 2022.
So can you give us some sense as to, did you finish the report on sometime in mid-July 2022? Would that be a reasonable conclusion from the date of the letter?
The analysis was completed earlier than that time, but the final product was in July, yes.
So approximately when would the analysis have been created or completed, excuse me?
Well, again, we do a lot of analysis, or have done a lot of analysis for, in this case, Duke Progress for many years. But for this particular update, probably would have started, I don't have the exact start date, but it was probably in March, early March, finished probably somewhere in June.
Is there Is there an interchange between your firm and Duke's in terms of, here's a draft for their review and comment, or I'm looking at certain data and I need clarification, or is it a clean handoff at some point, say January 1st, and then you come back to them in July with, here's the final report?
No, there is interaction that occurs during the course of the study. Some with property accounting. Again, I do site visits, which I believe I have listed here. The most recent site visit I took was in May of 22. I also took March of 22, so you can kind of get a feel for. That's kind of a lot of my interaction with going and looking at sites during that time period. The accounting records came to me before March because I would have had to review those before going to look at the facilities. Then after doing my facility work, I asked questions about accounting data that to understand any outliers or anything that would drive a life characteristic of an account. Make sure in many cases, is this consistent with what I see across the country? Or do you have something unique that's going on? That type of information I ask about and get follow-up information. Many of that's done during the site visits, but those are kind of the process. So from early March through the end of May, we do analysis. And then in this case, at the end of May, we do calculation for depreciation, which is part 9 of the study, and then provide Duke with our results.
So that would be, you'd provide them with the draft results sometime in June. Is that roughly correct?
It did happen near the end of June. I don't remember the exact date, but it for this particular one, I provided them what my results of the study are in June.
And from whom at Duke do you solicit comments about your draft report?
Well, again, I send it to property accounting or fixed asset accounting, and they will then disperse it to key personnel within Duke that needs to see it. And then it gets returned to me with any comments, if there are any, something that wasn't consistent with what everybody was expecting, or yes, this is consistent with what we thought. Move forward with the putting together the actual 688-page document.
And do comments come from individual employees at Duke or from groups, or how did they come to you?
Normally it's streamlined, collected by one person, and that gets sent to me. And again, property accounting is the main group that I work with. So they're the ones that collect all the information and will send it. So I don't always know whether there's a specific individual that gave a comment. But again, in most cases, by the time we get to that stage, there's a comfort level into what I've represented.
Is there somebody at Duke that gives a final sign off on your draft before you create a final report?
I would say that the person I address it to is probably the one that gives the final sign off. Just because, obviously in this case, I put his name on it, so he's got to be the one that gives me the okay. But I think it's a group of people. I don't necessarily think it's just one person that gives a final sign off.
So in other words, you would have typically Mr. Doss give his approval before you issue a final report. Is that correct?
Again, he may not be the one that specifically calls me and says, I give you approval, but I usually get contacted saying, hey, we had a discussion. David gives you the okay. And then I obviously, because was my main contact on this, I put his name on the letter, and then the document's finalized.
So, do you, in the course of your interaction with Duke, if you're proposing that the steam production plant, the coal units, be retired in 2027 and 2028, do you ask them what they're going to be replacing those units with? Is that an issue for you?
Well, normally within the IRP, there's some type of understanding as to what's going to replace it. So I will have a discussion as to not necessarily what specific asset, but are there plans such as wind generation or solar generation, renewables. They built an Asheville combined cycle facility in 2019 that covers part of those expectations. So those are things you could see on this page that you're referencing. There's a lot of major years of in-service dates that are within the last 10 years, which are new facilities that have come online that are kind of already addressing the need to meet demand for the units that are going to be closing.
So are you consulting with Duke's planning personnel, or are you simply looking at their public IRPs?
No, I'm communicating with them. And again, it may not happen every single study. We did this 3 years ago. We did it 3 years prior to that. So I don't always have to do every comprehensive discussion with them during every study, but I do follow up with them in this particular case, lifespan expectations, and then particularly in Mayo and Roxborough, because those are things that were changing. So when I went and looked at those facilities and walked around, talked to the operational folks, I had those discussions as to what was going on.
Okay, and just to be clear, I'm not asking about what you did in prior studies, really just this one. So when you did this study and you proposed these retirement dates or accepted Duke's proposed retirement dates for these units, did you talk with one or more people that are involved in resource planning at Duke, or look at their public resource plans to confirm that they have something in place to replace these units with?
I did review their IRP and I had discussions, not always direct discussions. So I won't, sometime it was, I ask a question, send it to property accounting then takes it to the planning folks and then returns the answer. So just to be clear, I don't always talk firsthand with those people. Again, because I do this every 3 years, it's not necessary. If I can get an answer to my question via either an email or when I'm talking to property accounting, say, hey, this is what I want to confirm. And then they call me back and say, yep, it's confirmed.
Okay, so did you get an answer to the question from Duke about what they're going to be replacing these units with?
As I mentioned, they're already starting the process of replacing these with some of the units I just described. So that is, as far as generation, they're already replacing it with some of these assets, which include the solar, which includes Asheville. And I'm sure there will be more. I don't have specifically what other things that they're doing, but renewables are definitely one of them. So that will be part of what is added over the course of that time period.
So is it your understanding that Duke is going to replace, sorry, let me ask an initial question first. The units that you're proposing that you've identified as being retired in 2027 and 2028, that you've identified as steam production plant, that's over 3,000 megawatts of coal-fired capacity for Duke, correct?
I don't have the exact megawatts for it, but
Would you accept, subject to check, that that's more than 3,000 megawatts?
it's definitely a big number. So subject to check, I'll agree with that.
Okay, and you understand that coal units are at least to some extent dispatchable, correct?
I agree. That's a true statement.
Right. And is it your position or understanding that Duke is going to be replacing these 3,000 plus megawatts of coal with non-dispatchable renewable generation? Because I heard you mention solar and I thought it maybe wind and a few other things.
Chair Mitchell, I'm going to say ask and answer it again. We have repeated the same litany of questions. I've tried to just let that go and make sure that FPWC had an opportunity to get its question answered, but it's the same question being repetitively asked.
All right, Mr. West.
I'd like to know, again, more specifically, what he thinks that that Duke is going to be replacing 3,000 megawatts of coal-fired capacity with. He's talked generally about their resource planning and the plan to add renewable capacity, but he has not said these 3,000 megawatts are going to be replaced with whatever assets, resources he thinks are going to be used. And if the answer is it's going to be solar and wind, then I may have some additional questions.
Well, Chair Mitchell, if I could respond. Obviously, Mr. Spanos is appreciation expert. He's not resource planning at Duke Energy Progress. To the extent that he was asked that question, he's explained, I think, more than twice, probably 4 or 5 times to Mr. West that he's been talked to about what options would be available, but the actual selection of those options is not Mr. Spanos' field nor his decision.
All right, I'm going to sustain the objection.
Mr. Spanos, you mentioned that you had been either in direct or indirect communication with folks that are involved with with resource planning at Duke, right?
I have been, yes.
Okay. Are you familiar with Duke's carbon plan?
I'm familiar with it. I wouldn't say that I'm knowledgeable of each individual state's or each individual company's plan, but I'm familiar with all the things Duke is doing.
Are you familiar with the filings that Duke made before this commission in docket E100 sub 179?
Well, Chair Mitchell, we're once again revisiting IRP planning, and I don't know where directionally this is going with the depreciation expert.
I'd appreciate a little bit of leeway. I think it'll be evident in just a minute.
All right, Mr. West, I've sustained Mr. Marzo's objection regarding the scope of this witness's testimony, and you have asked this witness, you've attempted to get information out of this witness now several times. Let's ask. I'm going to give you leeway with one question. Ask your question, and then let's move on.
If the chair would allow a little more leeway, I think at 2 or 3 questions, I can get the information that I need. So I apologize for that, but I'd like to know what his familiarity is with the carbon plan procedure or the docket, and then I can ask 2 or 3 specific questions that I think will provide some relevance to the line of questioning.
All right, Mr. West, I'm going to remind you that I sustained an objection made about the scope of this witness's testimony and that he is not a planning witness. So I'm going to let you continue to ask your questions, but I've already sustained the objection regarding the scope of this.
So are you familiar with the filings that Duke made in docket E100 sub 179?
I'm familiar that they made filings. The details of those, I am not familiar with.
Do you know when Duke made the filings?
I know we had a brief discussion about them. I don't remember the exact time period.
Okay. So
it was during the course of the study.
So 22 that Duke made a filing that identified multiple plans for the retirement of these same steam production or coal units?
May of 22 was during the course of this study.
Right. Are you aware that Duke made that filing though?
Madam Chair, answered again. He asked the question.
Mr. Marzo, let's just let him, that's a simple yes, no answer. He can answer that question.
I'm familiar that it happened during the course of the study. I don't know exactly whether it was May of 22, but it was during the course of the study.
Okay. Are you aware that this filing that was made during the course of the study identified the proposed retirement dates of Roxborough units 3 and 4 as sometime during a period 2028 to 2034?
I'm aware that there's a range, and these are probable retirement dates, which are the best estimation of the time that we expect these units to be retired. And that's the whole purpose of a probable retirement date. You have to take into consideration all the information, and then from there, come up with the probable date that is most likely to occur. And that's what we've done.
Sure, there is a range, but the numbers that you selected, 2027 for Roxborough units 3 and 4, is actually outside the range that Duke identified in its May 2022 carbon plan filing, which was 2028 to 2034. Are you aware of that?
Madam Chair, counsel is now testifying. He's not provided a document to the witness to allow the witness to assess the accuracy of counsel's statements. I think that's inappropriate.
All right, Mr. West, do you have a copy of the carbon plan that you can put in front of the witness?
I don't. I'm happy to ask the commission to take judicial notice of its order in the carbon plan. I can tell you that it was the order adopting initial carbon plan and
Well, Mr.
providing.
West,
direction-
that doesn't help the witness for purposes of
Excuse
his, that does not help the witness at this moment for purposes of his understanding.
I'm
what the
happy to
order
ask the witness to accept, subject to check, that the well-documented range that was identified for Roxborough units 3 and 4 was 2028 to 2034. Can you accept that subject to check?
All right.
Can you tell me what?
Mr. Spanos, let me address Mr. Marzo's objection, and then you can decide from there whether to ask the question. Mr. Marzo, I'm going to overrule your objection for now. Recognize the witness does not have the carbon plan in front of him and his prior testimony. The witness can answer to the best of his ability, subject to check, or however he deems appropriate. So, Mr. West, you may ask your question.
So will you accept, subject to check, that the carbon plan filed by Duke in docket E100 sub 179 identifies the proposed range of retirement for Roxborough units 3 and 4 as 2028 to 2034?
Before I do that, can you tell me what month of 2028 is part of that? I believe it's January, which is the same thing as 12/27 in my study.
Yeah, I don't recall.
Then I can accept it subject to check, but I believe the issue is it's January 2028, and that's the way I do studies, you do it at the end of a month, and that's 12/27, 12/31/27.
So is it your opinion that your dates are within the range? Is that your testimony?
I believe it's within the range of what was, what I'm familiar with.
Are you aware of whether the commission adopted a year for retirement of those units in the carbon plan docket?
I'm not aware of what the specifics were.
So I'd like to ask the commission to take judicial notice of the order adopting initial carbon plan and providing direction for future planning issued December 30 in docket E100 sub 179.
Hearing no objection, we'll take judicial notice of the order as requested by Council for Civil Public Works Commission.
Are you aware that this commission has previously ruled that the IRP proceeding is the appropriate venue for a thorough review of early or any generation retirements?
Can you ask that question again, please?
Are you aware that this commission has previously ruled that the company, referring to Duke Energy Progress's IRP proceeding, is the appropriate venue for a, quote, thorough review of early or any generation retirements?
I'm aware that the IRP is a component for determining depreciation lifespan dates. So if that answers your question.
You said that answers my question?
If that answers your question.
It doesn't. I was really hoping for a yes or no. Are you aware of whether this commission has previously ruled that the company's IRP proceeding is the appropriate venue for a thorough review of early or any generation retirements?
I think as I answered the question, that is a component of determining the planning process, but for determining a depreciable life, it takes into consideration more things than just the IRP.
Are you aware of any IRP that has approved that identifies the retirement date of Roxborough Units 3 and 4 as 2027?
And again, I'll answer in the same fashion I did before, that 1227 is the same thing as 128. And I think that's where there's a difference in what the intent was of the IRP and what is in my study.
So which resource plan are you referring to when you say 1227 is the same thing as 128?
No, I'm saying that in respect to my calculations, that a 1227 date and how I calculate recovery patterns is comparable to a January 28 date.
Okay, so let me ask you this way. Are you aware of an IRP proceeding in which this commission has approved January 2028 as a retirement date for Roxborough Units 3 and 4?
I don't know exactly the date, the official dates that were approved by this commission.
I'd like the commission to take judicial notice of its order accepting stipulations, granting partial rate increase and requiring customer notice issued in docket numbers E2 sub, excuse me? I'd like to ask the commission to take judicial notice of its order accepting stipulations, granting partial rate increase and requiring customer notice issued in docket numbers E2 sub 1219 and E2 sub 1193 on April 16, 2021.
All right, commission will take judicial notice of the order as requested.
Did you review the testimony of public staff witness Jay Lucas when you prepared your rebuttal testimony?
I did.
And do you recall that he testified that, I'm going to quote, DEP indicates in response to discovery that it has a plan to replace the capacity of Roxborough with hydrogen-enabled combustion turbines and combined cycle capacity, though its plan is not yet fully developed. DEP has not provided any such general indication for replacing generating capacity of the Mayo plant. Were you aware of that?
I'm aware that that is, excuse me, one of the things that are being considered for replacement of new generation.
Is there some basis to dispute his testimony that you're aware of?
No, but my point that I had made earlier in our discussion was there's various things that are going to replace the Mayo and Roxborough assets. Some of them are in place already, and some of them will happen in the future. And that's what my point was when I was saying there's not just one location or one asset that's going to replace all of the generation that is retired during those time periods.
Is it your understanding or expectation that natural gas will be used to replace any of this coal-fired generation?
I think it could be, and that's usually the basis for a combined cycle facility.
And did you evaluate the availability, current and future, of natural gas in this market?
I didn't look at every single region or area, but obviously Asheville has been built, which is a combined cycle facility. Lee has been built. So Sutton has been built. Those are combined cycle units. So there are the possibility of gas in the region.
So are you aware of any constraints on gas supply in this particular market?
Not to the extent that it will be the only replacement of Mayo and Roxborough.
So I want to ask you some general questions about survivor curves before we start looking at pictures. which I know is something that you greatly enjoy. So from what I could gather from your testimony and the testimony of the other depreciation witnesses, when you try to fit a survivor curve, you use visual matching, mathematical matching, and some level of judgment. Is that correct?
That's a pretty good assessment of the things, and part of that judgment incorporates company plans, growth, regulation, technological obsolescence, things of that nature. Those are all things that come into play when determining more than just a mathematical calculation.
Is there a particular weighting that you use with each survivor curve analysis, meaning what, for example, 1/3 visual, 1/3 mathematical, and 1/3 judgment? Or is it just vary from account to account?
It will vary from account to account depending on what's going on with that particular account. Some of them have higher growth. Some of them have more technological changes that will occur that will affect. Some are affected differently by other aspects of the company. So all of those factors come into play, but there's no mathematical calculation that says statistics are 1/3, judgment is 2/3. Nothing to that degree. A lot of it is, again, conducting studies for 30 some odd years that gives you an understanding of what would drive an account, how things would change. And I think that's kind of some of the things we've talked about with overhead conductor.
Is the mathematical analysis always material to the determination of the appropriate survivor curve?
If there's a substantial amount of statistical data to analyze, then the mathematical calculation is a component. I can't give you any more detail than that. It is, if you have enough statistical data, then it's something you have to consider.
So in this case, were there any accounts that are at issue between you and the other depreciation experts for which you believe there was insufficient statistical data to do a mathematical matching?
The 3 accounts that are in question, there was enough statistical information to have that as a component of the analysis.
So it was a material component of each of the 3 accounts, correct?
Can you define what material means? I mean, it's, again, part of what the analysis is, but I don't quantify each component.
Sure, but it was not immaterial to any of the analyses for the 3 accounts, correct?
I would say it was not immaterial, but it was part of the consideration.
And the accounts to which you're referring are 343, 352, and 364?
356.
343, 352, 356.
Yeah, and of those 3 accounts, 2 of those, I did not consider the statistical analysis to be a strong indicator of what's going to happen in the future, because the purpose of doing life estimation is to determine what the estimates are going to be in the future. One of them is that the other one is an interim survivor curve, which is only a partial component of life characteristics, because you also have the lifespan or truncation component. So in the 3 examples that we have in question here, I think that's why I'm responding in the fashion I am, that it's not necessarily those 3 accounts that going forward, the expectation is going to be the same as what we've seen in the past.
And for the benefit of the audience that's actually interested in this, the mathematical analysis that we're talking about is the the sum of square deviations. Is that correct?
That's the primary, the retirement rate method, which is the standard across the country, produces a sum of square differences component. So yes, that is the statistical matching that is utilized.
And is that typically represented as symbolically as R2? Is that right?
R2 is a type curve, but the survivor curve is matched with an average service life to get the life cycle of the asset category. So an R2 is just one of many types of survivor curves.
So let me ask you to look at the exhibits that were provided in the folder. And I'm going to ask that the exhibit behind tab 1, which is a discovery request to Fayetteville PwC data request number 4-2, be marked for identification as Fayetteville PwC cross-examination Spanos direct rebuttal exhibit 1.
All right, the document will be so marked.
Mr. Spanos, if you wouldn't mind, please take a look at the 2-page document. Let me know when you're ready to discuss it.
Two-page document, is the cover page one of the two, or?
You're talking about 4-2 document behind the tab number 1. It's a 2-page document. At the top right, it's labeled Fayetteville PwC potential cross exhibit 1.
So the first page is kind of a cover page, and then the
Yeah.
second page is the response. That's why I was asking.
Okay. So I'd like you to focus on the first page first, though, if you don't mind. So the first page says that this answer was provided by, I'm sure I'm not going to pronounce her name correctly, but Denise Lepisto, accounting or manager, accounting 1. You see that?
Yes.
Okay. Is this a person that works with or for you?
No, Denise works for Duke. She's in property accounting and one of the people that I communicate with quite a bit.
Okay, so is this an answer that you were involved in preparing?
Yes.
And do you adopt this answer as your own?
Yes, this answer is specific to statistical analysis that's being asked, but it is part of my response.
Okay, so if you would look at the response in section B at the bottom of the page. It's a series of years and apparently types of curves and then numbers associated with the curves. So the first B sub I is ages 0 to 42 years. You know what that's a reference to?
Yeah, ages 0 to 42 and the exposures of a life table.
Meaning for the units in question or for the asset in question, that was the universe of ages that were looked at from 0 to 42.
No, that was based on the question that was asked. That was the range of years that was being focused on based on the statistical analysis that was being questioned in the above, where it says DEP's proposed survivor curve is a good match in the historical data through age 42. That was what I was doing and explaining in my testimony, but that's not what is calculated in determining the best life estimation, because again, as I mentioned, you have to look forward as to what's going on, and there are other factors that are going to change the future. So This particular question was answering what was asked of us during that particular area, and it's only a statistical question.
Understood. But the goodness of fit through age 42, the 42 years came initially from you, correct?
42 years is the first 42 ages of exposures. And so when you're looking, in this case, you're looking at account 356 overhead conductor. So every asset that's added in 1960 has a vintage of 1960. That's age 0. In 1961, that has a vintage of 1960 has age 1. And I can go through all of the different years, okay? So you have 61, 62, all the way to 2021 in this case. So all of those ages reflect the exposures that allow you to develop a life date.
So immediately below letter I are the numbers 1 and 2, and immediately following those numbers are 65-R2 and 75-R2. Are those designations for the survivor curves?
Number 1 says 65 or 2.5, just to be clear, and those are survivor curves.
Right. Was it your position that 65-R2.5 is the appropriate survivor curve for this account?
For this account, when you take into consideration all the critical information, I feel a 65 or 2.5 is the most appropriate life characteristic for overhead conductor going forward.
Right. And then when it says equal after 65-R2.5, you see the number 0.99. Is that the sum of square deviations?
For that particular curve through the first 42 exposures.
Right. And then number 2, the survivor curve 75-R2, is that the survivor curve that was recommended by Ms. Tomczyk?
Yes.
And the number 0.67 after the equal sign, is that the sum of square deviations for that particular survivor curve over the 0 to 42 age range?
On a statistical basis, yes.
Right. So sum of square deviations, those scoring, is that like golf where the lower the score, the better?
If you were only doing a statistical exercise, yes.
Okay, so is it fair to say that, just to cut to the chase, that when you look at only the mathematical or statistical analysis, that the survivor curve recommended by Ms. Tomczyk for account 356 is a better mathematical fit across all of the three age groups that were identified in this discovery response, correct?
If you isolate the age groups here, the statistical numbers, the 75R2 does have a lower residual measure, but that's not the proper way to look at statistical analysis, because a 75R2 has a life cycle of 135 years, which is longer than the assets have lived and doesn't make sense on a go-forward basis. It's not a realistic life estimate for overhead conductor.
So I'd like you to turn to tab number 2. And I'd ask the commission that this be marked as Fayetteville PwC cross-examination Spanos direct rebuttal exhibit 2.
All right, document will be so marked.
And I ask you to look at the second page of this tab 2. And again, this came from Ms. Lepisto. Is this a response that you would adopt as your own to the particular discovery request?
I participated in the response to this question, yes.
All right. And you seem to be contending, in my words, that there's an issue with regard to transmission lines for this particular asset, correct?
Well, account 356 is overhead conductor and devices, so that is part of the transmission lines, yes.
Okay, does that also include distribution?
No. That's in account 365.
Excuse me?
That's in account 365. That would be distribution overhead conductor and devices.
So in the second sentence of the response, you indicated that if the Mayo facility is retired, then some of the transmission assets will also not stay in service and be retired. And that's really what I'd like to focus on. Are you talking about the transmission asset that goes from the substation to the transmission line for the substation that's serving Mayo, or what transmission asset are you referring to?
So at a generating facility, you have the main transformer, step-up transformer. From that step-up transformer, it then takes it to a substation or a switch yard that's right there at the generating facility. And then from there, you have 1, 2, or 3 lines, maybe 4, depending on the location, that sends from that substation or switch yard through the transmission line to the next substation. And then it'll eventually get to a distribution substation and be stepped down to that particular voltage. When you retire a generating facility, you're not going to need all of that all those transmission assets. So some of them are going to be retired, either because they're being replaced with a different type of asset, or they won't be needed because the whole purpose of that transmission line was to bring electricity from the generating station. So if you are in general concept, you're going to have higher levels of retirement based on going forward in transmission areas for all the different factors that I talked about, technology, growth, et cetera, that will affect the assets in this account, and why an R2.5 type curve is a better match than an R2 type curve. And in turn, when you look at the life cycle of the entire 112 years, the 65 R2.5 matches that a little bit better. And we can go to my rebuttal testimony where I show this picture, and you can kind of see the reason why, when you incorporate this information and the fact that retirements at age 60, 55 and 60, which is when generating facilities are being retired, you're going to see a higher level of retirement there. And that's what's going to bring it in line with the 65 R2.5. So you have to take that into consideration when developing your forecasted estimate. We're not trying to just replicate the past. We're trying to determine what's the appropriate life cycle going forward.
So since you've identified Mayo as an example, do you know, and you've been to the plant, I guess, a few times, do you know how much in terms of distance or the already depreciated costs we're talking about when you take Mayo out of service? I mean, are we talking about 100 feet, 3 miles? What distance are we talking
There's
about?
a lot of transmission line that will be retired. Not all of it will be permanently retired, but there will be a lot of transmission line that will be retired that is at age 45 or less.
Sure, but can you give us an order of magnitude? I know you said a lot, but again, can you give us feet or dollars?
There's not a specific degree of footage because it hasn't been determined yet, but we know that there will be retirements. This is what happens all across the country when you retire generating facilities. You retire the transmission assets or some of the transmission assets as well. So when you know that you're going to be replacing considerable amount of generation that affects transmission assets, it needs to be viewed as the ages of those assets, and that will accelerate to a certain degree the retirement estimates and amounts during these age intervals. And that's what you reflect in your statistical analysis and in making an appropriate judgment as to the curve going forward. I think it's not appropriate. The 75 R2 would expect a high percentage of investment to go beyond what we've experienced to date. And that means to assume reliable and quality service out for 135 years for conductors, not reasonable, which is what the 75 R2 does. The 65 R2.5 anticipates the assets all being retired around 112 years, which is consistent with what's happened for this particular utility.
So hypothetically, if Duke were to install new gas-fired generation or hydrogen-fired generation or some other asset in place of Mayo, would that asset not use the same, some or all of the same existing transmission system?
I don't believe it'll use all of the same. There will be some change to it, and the life cycle, future life cycle of those assets will not be as long as what it currently has shown.
Did you take that into account in your analysis?
Absolutely.
You did take into account the fact that there might be new generation located at the Mayo site.
I took into account that there will be replacement generation, whether it be at the Mayo site or not, but it's still going to create retirements because you're going to need different transmission lines that go through there. So there will be more retirements than what we've currently seen based on Mayo and Roxborough being retired.
Let me ask you.
All right, Mr. West, before you start your next question, how far into your cross-examination are you?
We are, I'm going to guess 10 minutes from being done.
All right, let's go ahead and
I'm
push on.
happy to stop whenever you'd like.
Push on.
So let me ask you to look at the documents behind tab 3, and if the commission would mark this third document as PwC or Fayetteville PwC cross-examination Spanos direct rebuttal exhibit number 3 for identification.
Go ahead. Restate your request, please.
I'm asking the commission to mark for identification the document behind tab 3 as Fayetteville PwC cross-examination Spanos direct rebuttal exhibit number 3.
All right, document will be so marked.
I answered my own question. So this is have you had a chance to look at the document?
Yes.
This is another answer that was provided by Ms. Lepisto. Is this accurate to your understanding, and do you adopt it as your own?
Yes, I do.
So I'd like you to, if you would, turn to page 20 of your rebuttal testimony.
Twenty of my rebuttal testimony.
Yes, sir.
Okay.
And line 2 is a picture or a depiction of retirement data and proposed survivor curves for account 356, correct?
That's correct. And it compares the 3 different estimates that have been for part of the case.
And just to be clear, this is the graphical depiction of the account the account 356 that we were discussing with regard to cross-examination exhibit number 1, where we went through the sum of squared deviation analysis for the various agents, correct?
Yes.
Okay, so when you undertake a visual analysis or visual matching, I think is what you call it, can you just kind of walk us through the basic process so everyone understands it?
Sure. In this particular graph, you have 3 experience spans worth of data. So you get an understanding of the overall time period, 1954 to 2021, that we have historical data. You have a more recent 40-year period and a more recent 20-year period. So the statistical activity that's happened during each of those time periods. Then what you see is, so this will, by age, it shows the percentage of retirements that have occurred to date. So it goes all the way down to 112.5 years, which is at the bottom of the curve. You can kind of see the squares kind of end at that time period. And again, this is what has happened to date. Then what I do as part of my analysis is take into consideration all information that I know about this particular account. So for example, I can look at the statistical analysis and say for band number 1, 75 R2.5 is the best match. However, that's not realistic because it assumes that 20% is going to survive at age 100 and the entire life cycle will go to 135, which is where that smooth curve ends. And we know that that's not the case. We also know that from age 40 to age 80, we're going to have a higher degree of retirements going forward than what we've had in the past. So that's going to bring, when we analyze this, that's going to bring all of those points closer to the smooth 65 R2.5 type curve, which is a representative expectation of typical life characteristics for overhead conductor. So when you take into consideration what's going to happen going forward, what's a reasonable estimate and the full recovery pattern of the assets as we go forward, the 65 R2.5, which is consistent with many others in the industry, and at the long end within that range, matches not only the data now, but over as far as a full life cycle, but what is expected going forward.
Thank you for the explanation. What I'm trying to get a sense of, though, is we talked about the mathematical matching, and then there were two other factors that we mentioned, visual matching and then judgment. And what I'd like to get a sense of is, as you look at this graphic on page 20, is it your position that from a visual matching perspective that your proposed survivor curve 65-R2.5 is a better visual match than the survivor curves proposed by the other parties, in this case, the public staff and Fayetteville PwC?
Never said that because I don't make a distinction between the visual representation at any point in time because I don't break it down like you were trying to get a percentage to be done. We do it all at once. So we don't go and say, okay, let's get a visual match of this and then make an adjustment. That's not how we do our life estimation. We take all the information in play and then from there determine what's the most appropriate life characteristic with all the information we have at once.
So if I understood what you said correctly, you don't engage in visual matching, you engage in mathematical matching and then some sort of a hybrid of visual matching and judgment. Did I understand that correctly?
I said I don't do just a visual matching first. All the visual, mathematical, and judgment all happen at the same time. It's all within the programs that we run to determine the life characteristics and all the different options that are available to us.
Okay, so let me ask you to look briefly at page 18 of your rebuttal testimony, questions 1 through 5.
Are you saying line 1 through?
The question and answer on lines 1 through 5.
Yes.
So here you seem to be identifying visual matching as a standalone process, which you described as visually making a determination as to how close of a match the smooth curve is to the original curve. Am I understanding your written testimony correctly?
The definition of life analysis explains visual curve matching and mathematical curve matching. We don't do them separately.
Okay, so you have not at any point looked at this graph on page 20 and concluded that your survivor curve 65-R2.5 is a better visual match than either of the proposed survivor curves of Fayetteville PwC or the public staff, correct?
I don't do the process that you just described.
And let me ask you to look at page 22 of your rebuttal testimony, line 2. Is it accurate to say that you have not looked at this graph on page 22, line 2 for account 352 and concluded that your proposed survivor curve 65-R 2.5 is a better visual match than the Fayetteville PWC survivor curve 70-R 2.5?
I have not just done that visual matching because I have to take into consideration that structures and improvements aren't the same as what they were before. We now put in modular facilities, so you have to build that in. So I don't just do a visual matching.
Okay, so you haven't made that vision. I understand you don't do the process. So in other words, the net or logical conclusion of the failure to engage in the process is you have not concluded on the basis of a visual match that your proposed curve is a better fit than Fayetteville PWC's, correct?
Yeah, sorry, I'm not gonna say that I don't put up on a screen the curves and see what they look like. I just don't do a visual matching and compare them like you're asking to do, because I make a determination based on all of the information available to me.
Okay, so when you put it up on the screen and saw what it looked like, did you at least intuitively determine which is a better match? Visually?
If I was to look at this and determine that the only thing that mattered was a visual match, and I'm only going to focus on the first 60 points or ages, I think it's close between whether the 65 or the 70 is a better visual match. But again, I take into consideration when I'm doing my visual matching, what's going to happen going forward. And I know that structures at substations are not the same, and the assets in the substation have security fencing, et cetera. So it's going to have a much shorter life characteristic.
I don't have any further questions. Thank you for your indulgence.
All right, redirect.
Thank you, Chair Mitchell. This panel, starting from probably what we've just ended talking about and working back up towards the front, you were asked several questions by Mr. West about mathematical and visual matching. And first, we'll talk about mathematical matching. Can you explain to the commission why mathematical fitting should not be the only factor relied upon in determining the service lives?
Yeah, if you, excuse me, if you refer to all authoritative texts and all the things that they tell you, they say, do not get ensnared by mathematical matching only, because you have different life characteristics based on each generation of assets, and you have to incorporate what's going to happen going forward. And you're not, the job of a analyst doing life estimation is not to match what's happened in the past. It is to predict what's happening going forward. And when you do that, mathematical matching, the only thing it can do is match what's happened in the past. So it's only a component of what you do. It's not a full analysis. So that's why you don't do it.
So based upon that, Mr. Spence, it sounds like you need to understand what is actually in the accounts that you're trying to determine the lives for. Is that accurate?
Absolutely. You need to know what's in the account and what's going to be added into the account going forward. So both of those things are important to understand.
Okay, and we talked a lot earlier about steam plant lives, and I'm going to ask you, it's similarly for steam plant lives. It's important to understand those assets when you come up with the lives that you.
It is very important to understand the nature of the assets, their function, all of that stuff is important to understand when determining life characteristics.
And is it fair to say that in order to understand those lives, you've got to communicate and get data points from the company?
Yeah, that's the only way that I know how to do it. I mean, that's how you're instructed to do it, is to get information from the company to determine what makes sense. So I obtain that information. And again, I've learned a lot of things over the years doing work for DEP.
Okay, and is that largely an iterative process that takes both clarifications and further understanding as to what is being evaluated, the numbers, the assets, and so forth?
Yes, I mean, you have to go through that process.
Okay. And you were asked a question about sign off on your report. And I'm going to ask you, the reports that you submit, you sign those reports, correct?
I signed a report, yes. So
Okay.
it's my document for Duke.
And when that document leaves your shop, it's because it is, to the best of your knowledge and your expertise, the correct depreciation rates. Is that fair?
That's correct.
Okay. Now, you were asked some questions about testimony of other witnesses in this case. And I'm going to ask you, as a depreciation expert, is it appropriate to just simply utilize prior depreciation rates that have been historically approved in prior cases?
No, because you have to take into consideration the changes that occur over time. Capital additions, retirements, change in nature of the assets, the plant to reserve ratio, all of those characteristics, as well as what the parameters are going to change, all of that has to come into play.
Okay, and as a depreciation expert, do you have to know the exact replacement of for example, we're talking about lifespans of steam plants, you need to know what the placement is in order to come up with the depreciation rate, or you just need to know generally what the company's plans are?
Yeah, I mean, in most cases, I just need to understand what the company's plans are and if they're planning to do a replacement. I mean, or understand that an asset's going to be retired. Those are the types of things you understand and need to know.
Okay, and the company doesn't come to you to make those resource decisions, correct? There are people within the company that do that.
The company makes those decisions and then I'll ask questions of it, but other than that, it's a company's decision. Obviously, they're the ones, running the assets.
Yep. Thank you, Ms. Spanos. Chair Mitchell, that's all I have.
All right, questions from commissioners, Commissioner Gladfelter.
Mr. Spanos, I've got some very basic questions, just to be sure I understand how all this works, but it actually does touch on one of the topics that you've been questioned about. So let's assume that we have an asset, and well, let's assume it's a generating plant, steam plant, and you've come to the conclusion in your best judgment that the likely retirement date of that asset is 2027. December 31st or January 1st of 2028. Doesn't matter to me, but you've made that determination based upon the process that you described in your responses to council's questions. Am I correct then that the next step in your work is to try to determine a rate of depreciation that will fully recover the remaining undepreciated book value of that asset by the expected retirement date? Let's leave aside net salvage and all of that. That's a complication. I understand it's there, but for simplicity purpose of the question, that's the exercise, right?
My job is to match utilization with recovery.
Right. And so you will then present, as you have done in this case, to us a recommendation about how to set a depreciation rate and include that in the company's rates it charges to customers that will yield sufficient revenue to recover the remaining book value of that asset by the retirement date that you've selected in your professional judgment.
That's a good assessment, yes.
Okay. And so if the asset, in fact, continues in service beyond the date that you've selected in your report, until there's another rate case, until the commission adjusts rates again, that amount that was included in the rates will continue to be collected by the company, right?
That's correct, but that's why you do studies on a regular basis.
Right.
Because you then get to reevaluate if there's been a change, company plans that have changed, and you can then, again, smooth systematically and rationally the recovery pattern over a new date. If it's shorter, longer, a different survivor curve, all of that information, so that you do, again, still complete the concept of matching utilization with recovery.
And the converse is true also, right? So if it turns out that the asset is retired sooner than the date you used in your report and recommendation, then until there's another rate case, that's all that's going to be recovered is whatever was put in the rates the last time, right?
No, that's correct.
And it may be insufficient.
That's correct. Again, why you continually review this information.
In the first case, if the asset stays in service longer, there may be recovery through the depreciation of more than the remaining book value. In the other case, there may be less. There may be a shortage. But that's a function of when the rate case occurs, isn't it?
To a certain extent, although.
Or the reevaluation, as you call it. I'll use your term, when the restudy and reevaluation occurs.
The only thing that I will say is with the remaining life concept, it allows you to not over recover. So it doesn't compensate for if you retire too soon, but on the remaining life basis, it builds in the fact that you need to, unless you add new plant, you're going to recover it based on that time period.
Well, that's exactly where I want to go. Tell me how that mechanism then works. Because again, take my hypothetical. In your study, you've selected 2027 as the date. Everybody's agreed that's the date for the retirement of that asset, most probable. And you've calculated what it will take to recover by that date, the remaining value of the asset, and that's put into rates, and the asset stays in service beyond that date. What's the mechanism that stops the over recovery?
That's why you can't really take away that net salvage component, because that's the piece that's still going on. That's still the part that adjusts these things and gets you to correct it by the time you do your next rate case. Because that happens after retirement.
You would adjust the net salvage, the terminal net salvage after the.
You would adjust the full recovery consistent with the terminal net salvage that adjusts that time period.
As I say, my questions were fairly basic, but I understand the mechanics now of how that happens. And it does have some connection back to the specific questions you asked about Roxborough 3 and 4, but you've helped me this afternoon. I appreciate it.
Thank you.
Thank you.
All right, questions on commissioners' questions?
I think I have two. Following up on Commissioner Clodfelter's question about an early retirement. There's actually a North Carolina statute that was adopted recently that allows Duke to securitize 50% of any balance left in an account if a steam plant is retired early and there's a remaining level of undepreciated value to the asset. Are you aware of that?
I am, but that's outside of depreciation study.
And then the second thing I wanted to ask about is he was mentioning the, December 31st versus January 1st, 27 versus 28, is depreciation rates are not set on a daily basis. They're set on an annual basis, correct?
Well, depreciation rates are annualized based on whatever the results of the rate case are. So as we were just discussing, if something, once you get approval of these rates, those will stay in effect until the next rate case. And they're determined as an annual accrual rate.
I don't have any further questions.
Mr. Marzo?
Just one. Mr. Spanos, Commissioner Clodfelter asked you some questions, kind of went into the purview of kind of what the impacts are to rates based upon depreciation. And I just want to ask you, when you look at things like plant lives, like steam plant lives, are you making rate-making decisions in terms of trying to set a particular rate, or are you just trying to get the lifespan correct?
Yeah, my job is to determine the most appropriate, either lifespan, survivor curve, net salvage percent, the most appropriate parameters that go into a depreciation study that should be supplied.
Okay, and you supply the information obviously to the commission, and all across, I'm sure in various jurisdictions, there are decisions made about how to recover costs. But at the end of the day, what you're trying to do is make sure, as Commissioner Clodfelter pointed out, am I correct, to make sure that customers who are getting the benefits of that service pay for it during the lifespan of that plan?
That's exactly right. And that's the definition of depreciation.
Okay, thank you.
All right, at this point, we've come to the end of Mr. Spanos' testimony. Thank you for your testimony this afternoon. You may step down and be excused. I'll entertain motions. Actually, let's start with Duke.
Yeah, I would just ask Chair Mitchell that Spanos Exhibits 1 and 2 and Mr. Spanos Appendix be entered to the record.
All right, that motion will be allowed. All right, Mr. West.
Fayetteville PwC would move to admit Fayetteville PwC cross-examination Spanos direct rebuttal exhibits 1 through 3.
1 through 3. All right, that motion is allowed. All right, we're at the end of the day. As to outstanding motions to excuse witnesses made by the public staff, motion is allowed as to Childs and McCullough. With that, we are done for today. We will be back on the record at 9:30 on Monday morning. Thank you very much. We are adjourned, or we're in recess.